We wonder if the consumer is beginning to bend, not necessarily break.
I think the last thing consumers need at this point in time is a spike in oil prices and gas prices.
Does energy drive the economy, or does the economy drive energy?
Oil prices going up, even for a short time, just complicates this narrative for the Fed.
Figuring out when to stop the rate hike cycle is always a really, really tricky business for central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Difficult, tough couple of days on the S&P 500. Futures lower again this morning. Apple front and center at the epicenter of our conversation this morning. Apple negative by 2.7% in the pre-market. Some reporting here at Bloomberg. Allow me to share it with you. China plans to expand a ban on the use of iPhones in sensitive departments, Tom, to government-backed agencies and state firms as well.
Yeah, there it is. It's a headline. The other one is that the two of my iPhones are broken at home as we get ready for the Apple meeting here coming up in next number of days. The Apple drawdown, John, is 8% from the recent intraday peak. Yeah, it's a pullback. But again, this has happened before, but I take your point. Is this time different? And I think it bears a lot of scrutiny by Mark Gurman and our team on the Pacific Rim.
You're right to mention September 12th. That's the iPhone launch. A new iPhone, the 15. China's really, really important. A fifth of revenue for Apple. And Bramo, it's not just this line. It's the competition you might get from Huawei as well. How difficult are things going to be in that country for this new launch?
Especially if you can tell that the authorities are not particularly on Apple's side and are actually working actively against them. You asked me yesterday, who has more to lose if the Apple-China partnership breaks apart? And I kind of hemmed and hawed and didn't really know. And I was looking at the millions of people that Apple employs and the ability of China to really reignite confidence in its international businesses and how much they're open to business. What does that do to this if they do really break in and erode Apple's position?
This goes to Catherine Mann now at the Bank of England and her arch work at Brandeis years ago, the codependency between America and China, the codependency of Apple with, I'm going to call it basically the Chinese labor model. And I think your point of millions of people involved is not off the mark. And John, you know, I wonder how much of the quote unquote government is going to be all Huawei and not iPhone. Do we know yet? I think the answer is we don't know.
Well, how much of the public will be all Huawei and not iPhone? That's the more important question for the likes of Apple. I also think from the perspective of Tim Cook, the diplomat, he's been phenomenal at that for years, being able to play both sides of that tension between the US and China. And clearly what this story, Tom, conveys is that China sees Apple as a US company. As a US company, which is why we're seeing those bans at the government level for staff in those agencies.
Well, the answer is pull back. We're back to a level, I'm eyeballing it here, early summer level on Apple. They've had a hell of a run here over the last number of months. And the answer is we'll have to see. Again, my focal point here is how big is that government exclusion of Apple products? I don't think we know.
And does it spread? Does it stir up some nationalism, whip up that kind of patriotism?
Well, the nationalism's there already. There's no question. The anti-American sense is there, but they want their toy. They want their iPhone, just like everybody else in the world.
Equities right now on the S&P 500, more broadly, negative by 0.25%. Apple lower by a little more than 2%. So futures lower again. 2 days of losses on the S&P 500, down a little more than 1% over that period. Yields come in about a basis point on a 10-year, 426.59. Tons to talk about in foreign exchange. Just about holding on to 107 for the euro. Lisa, the euro right now, 107.14.
And Kit Juice coming out this morning and basically reiterating why even have it this high, considering some of the pressures on the euro. Today, what we're looking at, 8:30 a.m., we get initial jobless claims and non-farm productivity. 10:30 a.m., the FDIC is releasing a quarterly report in the banking system. I'm interested in that. But really, it's jobs, which is going to be front and in the focus. If the jobless rate is ticking up just slightly, where is it in the jobless claims filings, which have not ticked up in any meaningful way? Today, who isn't speaking on the Federal Reserve? I'll just give you this. Philly Fed's Patrick Harker, Chicago Fed President Austin Goolsbee, Atlanta Fed President Raphael Bostic, Fed Governor Michelle Bowman, Dallas Fed President Lori Logan. But the big event is John Williams, our New York Federal Reserve President, who is going to be speaking to our own Michael McKee at 3:35 p.m. in New York.
You missed the punchline. I'm the warm-up act.
Are you?
I'm going out there with Torsten Slok and a bunch of worthies, and we're going to talk about foreign exchange and global macro. And then they booked some guy after me called Bloomberg, and he's going to show up to introduce Michael McKee and John Williams. You know, I mean,
okay.
Talk about. I'm the afterthought here.
Let me reset. Tom Keene will be speaking today, and you might want to pay attention to that. There also are some Fed speakers as well. Also, President Biden is going to be departing the United States to head to the G20 meetings in New Delhi. There are a couple things here that are really important. First, how much does President Biden take advantage of the fact that Vladimir Putin and Xi Jinping are not showing up? Does he sort of solidify the alliances there? And number two, what's that meeting with Saudi Arabia like with all of the oil output cuts?
Fist bumps and all that?
Well, you think they're going to be fist bumps?
No idea.
Anyway, that's what I'm watching today.
Looking forward to it. Tony Dwyer joins us now, Chief Market Strategist at Canaccord Genuity. Tony, wonderful to catch up with you, sir. Light and tight was the diet for you in the summer. Is it still light and tight? And what would it take to make you positive on this market?
Yeah, it still is, John. As you can see, I'm a little bit under the weather, but you've got to have a dramatic improvement in credit. And I know the first response is anybody in our business is going to say, what are you talking about? Corporate credit spreads are tightening, but they're tightening mortgage spreads, corporate credit spreads. They're tightening because the 10-year is going up. They're tightening for the wrong reason. I cannot find a soft landing scenario, whether it's 1966, 1995, or any recession-based recovery. Any economic weakness is always associated with a significant sustainable drop in rates that has not happened. The absolute level of rates remains high. And so as you guys know, I believe that the soft landing scenario is the worst case scenario because it keeps exactly what we're seeing. It keeps inflation elevated and it keeps the Fed higher for longer, which gives more time for resetting a debt to have to do it at a much higher level.
Tony, I look at where we are, and there's a paper merger going on now. I just looked at something called Smurfit Kappa Group out of Dublin, and they're trading at a PE of 10. I believe there's 7 stocks trading a little bit higher than that. I see minimal evidence of a broadening out of the Standard & Poor's 500 if we hold on or even if we advance into 2024. Do you see any ability of SPX to broaden out?
Well, it did for a little while over the summer. We had talked about the hustle of the Russell and, had looked for a trade up to 2,000 on that index. The problem is, Tom, everything is temporary until you get that dramatic improvement in credit. Like, let's say the economy's okay. Let's say somehow it's going to mystically after the fastest rate hike cycle in history into a generationally leveraged system with quantitative tightening. Let's just say it's not going to impact anything. It's all good. How are you going to get, when you're already at full employment, how are you going to get that double-digit earnings growth next year? Now, some of it can come from AI and productivity. We get those numbers today. But real double-digit growth with flattish revenues is a really tough call when you're already at historically high margins.
Tony, you talk about light and tight and staying in that level, in that sort of protective stance, with the expectation that only if yields materially drop will you see something that's more constructive. What could make you that much less constructive on the other side, especially the soft landing scenario that you talk about, if it starts looking a little bit more likely?
Well, I just don't. Lisa, it would be so historically unique to see a soft landing here without a recession. Where I'll be wrong is if nobody cares that the recession's coming. Now, the reason to explain what light and tight means, it means have a little extra cash and be tight to the benchmarks. However, a little bit obviously more defensive based on my tone. But the reason it's not get the hell out is because so many stocks are already down significantly. I just looked at the S&P 500 department store sub-index. Holy cow. Like that. A lot of stocks already reflect the kind of economic outlook that I'm talking about. So the time to really be super negative, which we were, was last summer and last year when you knew the Fed tightening cycle was directly ahead of you. Remember, it starts out as good news is bad news because it means tighter Fed. Then bad news is good news. We've been in that. It means the Fed's going to stop. But ultimately, bad news becomes bad news. And when that happens, I want to attack the weakness versus trying to play it. So I think, just kind of staying out of the way when your earnings yield is below the risk-free rate of return. I don't have to guess, guys. We don't have to guess. You're getting over 5%.
Tony, I've got to re-listen to that to make sense of it all over again. Can you tell me what conflicting news means for markets? Because yesterday there was some tension between the Beige Book, which painted somewhat of a soft landing picture, slowdown story. Then the ISM said, boom, let's go. Tony, how much weight should I put on one versus the other?
So, John, that's a great question. So the bee in my bonnet lately has been that if you look at the establishment survey, and I got this idea from my friends at Med Davis. So the establishment survey, which publishes the payroll numbers that came out last Friday, as you guys know, there's been a huge amount of revisions. The prior 2 months were revised down 110,000 jobs. How did 110,000 jobs in 2 months? And the reason is, guys, get ready for this. The establishment survey, initial reach out from the government to the business. In other words, participation, initiation of the conversation, that rate in 2015, that initial reach out rate was over 70%. It's currently 32%. Only 32% of businesses that, by the way, pay taxes to the government are answering the question on the call. So the idea that any of these economic numbers should be used is just
hold on a second.
Outside of the realm for me.
This is pretty profound, Tony. Are you saying that either the beige book is more accurate, that anecdotes are more accurate than the hard data that doesn't have a high response rate, or just that you have to look entirely outside of the official data because it's all inaccurate and not giving a correct read?
I believe that's true. So what I use, Lisa, is I use those organizations, like the ISM is good data generally, because it's an organization where the member firms are incented by being part of the organization to answer the question. But every other government-based data series, guys, go back. I got this great new assistant. His name is Google. Google soft landing scenario, soft landing Bernanke, soft landing Greenspan, soft landing Yellen. It's always a soft landing until you get to that hard landing. But again, just to be super clear, I want to buy the weakness versus trying to play it. I just don't see how you're going to get double-digit growth in earnings next year when you're already at full employment and absolute level of rates remains at the cycle high.
It looks soft until it's not. Tony, thank you, sir. I know you're a little bit under the weather, so feel better, buddy. Thanks for joining us this morning. Tony Dwyer there of Canaccord Genuity. Light and tight, TK, until we start to see some real weakness.
He's been really, really good about this. I mean, he's in the market like a lot of other people. You can't be 100% in cash unless you're me. But the answer is, he's been cautious into this and looks smart given the flatness that we've seen. Not so much the drawdown. I don't know if you guys, I was out yesterday, folks, had to get Afterthought back to school. She's taking physics.
Nice.
Taking physics.
Cool.
She went to school with my slide rule. I teared up. She took her slide rule.
You walked in the heat.
We walked in the heat. It was brutal out there. And the heat out there, I wanted to get to that, John. You follow this way more than I do. U.S. Open. I mean, Abramo's got box seats. But 502,385 people attended in the first week. That's ginormous.
Never mind the attendance. Try playing in it. Danny Medvedev yesterday.
5 sets, you got to go.
Warning that someone's going to die potentially, Tom, in that heat. It's a real problem. They've got to work this out at the U.S. Open. It's so hot for those players.
Full disclosure, I think it was last year, the year before, and I was not impressed. It was way too packed. It was like I felt like a sardine. It was just packed.
But this is next level heat, right? I mean, if you're playing
this is way worse.
Top level athletics in 95-degree weather that feels like it's 108-degree weather when you take a look at the humidity, and you need an ice bath and you're feeling like you're going to pass out and die afterwards, when do you just say, okay, we're going to postpone it? But he acknowledged that's messy. People have a lot of money involved.
5 weeks ago, 6 weeks ago, in the Midwest heat, a San Diego Padres pitcher went down on his knees on the pitching mound, and they had to come out. I was surprised they kept him in the game, but they had to resuscitate him with Tang and whatever they use.
Is that what they resuscitate?
Yeah, Tang Zero. It works.
Just a straight shot of vodka.
There's another story here as well, Tom. If you have Spectrum, you weren't able to watch that anyway.
Yeah, what is that?
It's some weird fight, and it's embarrassing right now for Spectrum and ESPN, because even the players are talking about their inability in their hotel rooms to watch the actual tennis themselves.
Small detail.
We'll catch up with Michael Nathanson in the next hour on that story. Looking forward to that. Seema Shah in the next hour as well at about 7 a.m. Eastern Time. Live from New York City this morning. Good morning.
Wonderful.
It's probably wise from a risk management perspective and probably necessary based on the data that we've gotten that they keep that extra rate hike in there. The committee has to be ready to react, and in a way that doesn't shock markets. I think markets should be putting some probability on that possibility, even if it's not maybe the main the main possibility here going forward.
Jim Bullard the Fed whisperer, even though he's no longer at the Fed?
Yeah,
the former St. Louis Fed president, Jim Bullard there. I thought you might be a little quieter since you left, Tom.
For those,
he's been talking week after week after week after week, and sometimes multiple times a week.
And on radio, you can't see it, but he's out at Purdue. You know, I think he's doing something with a football program.
With a questionable tie shirt.
Yeah, they play Virginia Tech this weekend.
Hey!
You know.
I thought that's the direction you were going in.
Well, there's that as well. It's a new look.
Commentaries, really.
Slightly questionable, wasn't it? What was that, like a brown jacket with a light blue
like
on
West
light
Lafayette.
blue?
You know, when you go to Harry's Chocolate Fountain Shop, whatever it is out there, we're doing a remote from there, you know.
I know.
It's scheduled for May next year.
Can I
Look forward to that.
issue with this idea of a Fed whisperer? I think it's more like a Fed megaphone. I mean, honestly, like how many times can you broadcast it? Anyway,
okay, well, let's stop the show right now.
Insight there,
okay.
Is there some insight?
Let's do it here. What's John Williams going to say today to Mike McKee? What's going to be his message?
Patience.
Does he reaffirm
I'll tell you what the interesting conversation will be with John Williams and Mike McKee. John Williams has already set us up next year for something very, very intuitive, which is basically as inflation comes down, what they don't want is for real rates to go higher. They don't want policy to become more restrictive. They want to maintain restrictiveness. So he's talked about this on the record. I'd like Mike to probe just a little bit more, because I think the optics of that conversation are counterproductive. I think at this point of the effort to get inflation down, you don't want anybody talking about rate cuts. And John Williams has gone there. So now he's gone there. I think Mike McKee's going to have a little play around with that conversation.
I'd like to see if he reaffirms we're going to go back to a low R starred, which is his territory, and that'll be something. We'll see this afternoon, folks. Michael McKee in conversation with the gentleman from the New York Fed. Right now, the gentleman from emerging markets, Damian Sassower here, in the tumult, the mystery you have about China, about Japan as an EM, 147.48 on yen. But we're going to go a bit wonkish this morning, as Professor Krugman would say. Damian, we're going to talk about what matters. To me right now, the real rate in the United States matters, the inflation-adjusted rate. I don't have a quote this morning, 1.97. In your world, relative real rate differentials matter. So explain the real rate of Indonesia versus the real rate of pick another country.
So good that you picked Indonesia. They're one of the few countries now where market-based measures of real yields have actually turned positive, Brazil being another, Chile being another, et cetera. But what's interesting is if you look at real yield differentials between emerging market countries and the U.S., their local currencies tend to track that pretty well over time, right? So real yields matter. But, I mean, I think what we're seeing here now with Chile, with Poland more recently overnight.
That was a big cut from Poland yesterday,
75, very unexpected. I mean, there's an election coming up, but no one saw this one coming. And, you know, look, I mean, there's a cost of living crisis going on in most emerging markets right now. And if these central banks start to jump the gun and react to it, their currencies are going to suffer off the back of it. The zloty is down and down big today, and it's because of that big cut.
Doesn't this raise questions about what's happening just across the border with the ECB? So you've got the ECB potentially hiking next week, a week today, and you've got Poland cutting from 6.75 to 6%. What's happening there? Can EM really go in one direction and the ECB go in another?
You know, I mean, normally you don't see that. I mean, whether or not the ECB actually delivers on that hike remains to be seen, right? I think that's the big question right now. Look, I mean, everybody's been talking to me about China, right? We've got 733 on dollar yuan, and everyone's saying, what's the spillover to Europe more specifically, because we know there's a bigger corollary between Europe and China as opposed to U.S. and China. I mean, China, guys, I mean, we're talking 50% of global commodity demand. We're talking the second largest, economy in the world. You just can't avoid it. And so what you're seeing there when, I think what the market was hoping for was some big bazooka stimulus to come in. But if they try to come in and stop the devaluation of the yuan, forget about it. That could destabilize the yuan itself. And its whole premise as being a reserve currency, a trade currency, will be thrown under disarray. And you're going to see capital outflows, such as what we're seeing, Lisa, from BlackRock and Fidelity more recently.
Which perhaps is the reason why we've seen more than 50 days of a stronger and the strongest peg for the yuan versus where it comes in, which is the longest streak going back 54. To at least 2018. So you are seeing an effort on that level. But is there a feeling, and maybe this explains some of the rate cuts in Poland and elsewhere, is there a feeling that a weaker currency could benefit certain economies at a time where growth is found in the U.S. but is scarce in other places, and exports is a key indicator and a key mechanism?
And you saw the trade data, right? But I'm of the belief that the gains from increased exports due to a weaker currency is not nearly enough if you're talking about devaluing the yuan, right, and destabilizing the yuan, and the capital outflows that can come off of the back of that. I mean, we saw Apple overnight, but forget about that. I mean, we're seeing capital outflows out of China. We've seen that for the better part of the last year plus. And I'm talking now we're seeing fund managers in junk debt, which is illiquid, which you really can't sell out.
Wait, hold on a second. Are you saying that what happened with Apple and China will actually prompt more investors to withdraw cash from China?
Well, I think, yeah, well, let's think about China. China is using Southeast Asia as sort of an intermediary to deliver goods to Europe and the U.S., right? So all I'm seeing is more of a rerouting, so to speak, of components and what have you. But yeah, no, I absolutely do think trade's going to continue to go down off the back of this. And look, you were mentioning a little bit earlier, like, what does this really mean? Is it's not households in China who are not going to be using Apple phones. It's those employees at state-owned enterprises. Well, those state-owned enterprises, Sinochem, Sinopec, CNPC, employ millions of Chinese. And if they stop using it, rest assured, it's going to spill over to the households, and you're going to see a huge impact on trade.
You know, I got in Beijing, and I'm thinking of the Economist McDonald's Index, and I'm looking at a Big Mac in the Beijing for $1.90, or maybe it's $2. What do we know? It's 13.9 yuan, whatever that is. The answer is it's dirt cheap. Where is fair value on China? Do we have any metrics that say to us they're going back to 2005? It's undervalued now. It should go up. What's the value that we have there?
A fair value on a currency. I mean, if you look at anything like Big Mac, if you look at purchasing power parity, I mean, it's going to be very, very tough because the inputs that you're using for China just don't really add up. So all you can really do when you're trying to assess, the near-term direction of the yuan is look at, as we mentioned in the beginning of this conversation, real rate differentials. And if you look at the yuan and you look at the Japanese yen and most Asian currencies, they are now funding currencies. So it makes sense that when you see this risk-on mood, U.S. exceptionalism and otherwise, people are going to put that carry trade on. They're going to carry in the economies with high real yields, and they're going to sell those with low real yields, and that's what's impacting Asia currencies more specifically.
Have we got a decent read on their treasury holdings at the moment?
It came in last night. It barely budged, John. I mean, we don't audit that, so 3.1 trillion in FX reserves in dollar terms. I don't put much stock in it, unfortunately. I used to really love that number. It used to be at like 2.5. It was going up to 3. We're like,
why don't you love it anymore? You just don't believe that's the actual number?
Yeah, it doesn't move any much. I mean, I don't know. I just don't know enough about how it's calculated, unfortunately. I don't have transparency there.
This morning, Eric Schatzker will speak with a gentleman from Canada, Mr. Trudeau. Sassower on Looney.
Yeah. On Looney. That's a little bit out of my remit.
It's an emerging market.
But they did hold yesterday.
The Maple Leafs are terrible. The Canadians are terrible.
An emerging market.
It's an emerging market,
okay.
Yeah.
I mean, look, if you want to talk G20, the original G7 was a G6. It was Canada that made it a G7. So let's look historically on how important Canada is to the developed market world. But taking a step back of that, this G20 meeting that's coming up, not having China there, is not really, a message directly at the U.S. I think you can't ignore what's going on with China and India, right? Especially on the heels of the BRICS conference, right? I mean, there's a little animosity there. Can't be ignored, and it's something that I'm keeping a pretty close eye on.
And Apple, once again, in some ways, are the epicenter of that as well.
I agree, yeah.
And South Korea with SK Hynix and these chips that are finding their way into Huawei phones. It's all coming together.
It's a fascinating moment. Damien, thank you. Damien Sasser.
I'm really big on his thought there on India and
Indonesia,
China as being under.
India, China, Canada.
No, but
as well.
Canada.
You're going to get some lovely emails this morning. Remember when Trudeau wanted to be the dean of the G7? Still entertains me. What's that about?
Well, we're going to have it's going to be a spirited conversation. Eric Schatzker with Mr. Trudeau at our new economy.
In about 20 minutes' time, yeah. We'll bring you some of that. If you're just tuning in, welcome to the programme. Equities look like this on the S&P 500, slightly negative. We're down by 0.3%. Later this morning, some jobless claims in about 2 hours and 5 minutes from now, and a ton of Fed speak. Lisa went through the who's who. It's kind of like who isn't speaking on the FOMC a little bit later today.
Tom's speaking too.
TK's talking as well. Don't forget that.
Warm-up act.
TK's the warm-up act for the Fed speak a little bit later. From New York City this morning, good morning to you all. This is Bloomberg. Bramo already planning a next vacation.
It's just amazing.
Unreal, isn't it? equities on the S&P 500.
Why don't we just book Rick Steves for an hour?
Negative here by about 0.25%.
Bramble where to go.
Let's whip through the price action. On the NASDAQ, we're down by 0.6%. Down across the board here, the Russell, just a little bit softer, down by 0.1%. The NASDAQ, I guess blame Apple. We'll talk about that in a moment. The stock is down by 2.7%. In the bond market, 2-year, 10-year, 30-year, the 10-year yield 4.2678. It's down about a basis point today, but the 10-year over the previous 3 days of yields climbing ever higher. Tom, getting closer and closer to that cycle high, just shy of it by about 10 basis points or so.
There's interest there in the 10-year and the 30-year, but I'm going to go short here. The 2-year yield pushing 5% right now. The 3-month T-bill bursts out to 5.44%. We're going to get a 30-year bank rate mortgage here. I think that comes in the next couple hours. Right now up at a record high. And, there's just enough things pushing up where you go, what are the ramifications if we get to the next level of higher yields? I think there's a great unknown there.
Dollar dominance.
Yeah, no question about that.
The euro just holding on to 107 at the moment. The euro against the dollar 107.10. The dollar, I didn't realize this until this week. The dollar index advancing for 8 consecutive weeks. This is week 8.
Yeah,
so this is 2 months of this now, Tom. Just this grind.
You take
this dollar strength story.
You take the two indices, the DXY, which is the major trading partners, and then the emerging market Bloomberg statistics, which are actually better, and there's just an inertial force here, a stronger dollar. Explain to me how that reverses, and other than gross Fed action, which I don't think anybody thinks we're going to see.
Just south of 105 on the dollar index. Let's get to the data for you and a whole bunch of stories as well. Under surveillance this morning, China planning to expand a ban on the use of iPhones in sensitive departments to government-backed agencies and state companies. This according to Bloomberg reporting. The move posing a threat to Apple's position in a market that accounts for about 1/5 of its revenue. This stock, Tom, is down 2.7%.
Pulled back negative 8% off where it was a number of weeks ago. There's a drawdown of 8%, and that's all fine and well, but I'll be fascinated how they respond. You mentioned earlier the diplomacy of Cook of Cupertino. It'll be just really interesting to see. And I have no clue on this. I defer to Mark Gurman and some of the other people we talked to, but how do they respond to this? With silence? I don't know.
Next week is big. The unveiling of that iPhone.
And made bigger.
And a deadline for these talks between unions and Detroit. The United Auto Workers planning to make a counteroffer to Ford after rejecting the company's first proposal. Ford's offer, Lisa, included a 9% wage increase plus a $12,000 cost of living assistance. But that fell well short, of course, of the 40% wage increase the union was initially seeking.
Didn't the union call that offer insulting? Wasn't that sort of some of the language that they talked about? So while this is happening, today there's a meeting happening between General Motors and the union leadership to try to figure out what's going on with that. A lot of people have said Ford is really the leader here because they will be more amenable to certain union terms. Either way, if the union gets what they want and what they're asking for, that would be $80 billion of extra costs for each of the Detroit major three. And that, I think, is what people are looking at from an investing standpoint. Okay, well, what does this do to free cash flow and profitability? But on the flip side, you need the workers, and they want to get paid.
How do they compete with Tesla?
Yeah.
How do they compete with China? Even the German automakers, they're very, very concerned. You can tell about the competition coming from China and whether on a cost basis they can actually compete.
Yeah, and this has been an ongoing concern, especially with the electric vehicle push, right? How much of the union anger is really stemming from certain policies that prioritize electric vehicle production and that might come at the expense of some of the workers in the rank and file.
My basic take on this is there's a cross current going on right now. You mentioned EV, and yet I'm reading a lot from Bloomberg. Are EVs really selling? Where's the depth of the EV market that they've bet on? And then the other thing I look at here is the history where they pick one company, John. They don't strike against all of Detroit and Dearborn. They usually find the company they want to strike against. That's a tradition. Do they stay with that this time?
Well, to Bramo's point, it seems like talks with Ford on a relative basis a little cozier than talks with the others?
There's a theory that I was reading about over the past couple of days that in union negotiations, they go after the lowest hanging fruit. And then they use that as a template to form the agreements with some of the other manufacturers. In this case, Ford seems to be that one, and that's why they're going after.
So beat up on Ford first.
We'll try to extract as much as you can.
Right?
Here, I got a run rate off the Bloomberg. Ward's total vehicle sales is not the boom time of years ago, 16, 17 million. I got a statistic of 15.4 4 million. So it's not a make it to the max auto industry.
I want to finish on this story. Gas prices are higher. They're particularly high for this time of the year. Crude is back to about 90. And then this drops. The Biden administration cancelling leases sold by the Trump administration in 2021 to drill for oil in the Arctic National Wildlife Refuge in Alaska and planning more conservation in the state's petroleum reserve. The moves after Biden controversially approved ConocoPhillips' 600 million barrel project in the reserve back in March. Now, Lisa, this is a curious one because on the surface, you can say it's Biden against the energy industry. And then you look at the data and output in America is at 12.8 million barrels a day and just shy of a record. So I'm not sure what to say about this story this morning.
You frame it perfectly. I don't think you can overarchingly say this is the Biden administration against big oil. This might be a question on messaging and how you cater to both environmentalists while also fostering an industry that's crucial, right? I mean, energy independence is increasingly crucial, and that's quite clear. And even the Biden administration has kind of hemmed and hawed, but kind of, hinted that they can accede to that this is actually helpful. So I don't know that we can make something bigger about that. But I will say I was in Alaska recently and in one of my vacation plans. And so I can understand some of the vast wildlife and the tension with even people who live there who really enjoy the drilling and want that to foster the economy and to foster jobs at a time where there isn't much.
But as a tourist, you don't want the eyesore of the drill when you look from your cruise ship.
Okay, right? First of all, I did not go on a cruise ship, okay?
Did not go on a cruise ship?
We're
selling cruise ships today.
We're not going to reprise this
Cancel that ad.
I will just say, but yes, it would be.
She's longitudinally, I want her life. I mean, she's in Norway, going over to Greenland to see polar bears, and then she's in Alaska.
It's well earned.
It's like she
continues to write the newsbasic on vacation, though, which is impressive. That's impressive.
Work from V, WFV. Yeah. My basic point on this, and this is with the death of Bill Richardson of New Mexico, an energy secretary. John, we don't have an energy policy. So this is the Biden policy. But who's ever in office in 4 years, whoever that may be, they're going to have a whole new policy.
Yeah, that's
We're
the
making
criticism.
it up as we go.
I would agree with you. So the oil producers, the energy players, are in a bit of a tough spot, Tom. How do they plan?
Yeah, I'm taking a vacation. My goal is to get below 59th Street. We'll see if we can do that. Let's move forward here. An eventful week, to say the least. Jennifer McCown is chief global economist, Capital Economics. They write terse, really trenchant reports. Jennifer, I want you to validate the IMF call of a global tepidness out 5 years. Does Capital Economics, with the battles of China, all the other things out there, do you look for subdued global GDP forward?
Well, in the short term, absolutely. We think there are a lot of headwinds, but most obviously stemming from tighter monetary policy. A lot of that's yet to come through. I think we will see a recovery in advanced economies after this sort of period of weakness. And in particular, we're pretty optimistic about the effects of artificial intelligence on productivity growth. So looking out to those kind of 5-year horizons, I'd be a bit more optimistic, but not so about China. There are clearly major structural headwinds from China, stemming particularly from demographics, its state-led model, which mean that we think we've long expected growth to be slowing to kind of the 2% type level. Well,
that's right where I wanted to go. This is important. You got Capital Economics is modeling a 2% China GDP.
Yes, out by kind of in the next 10 years. Yeah. So a significant slowdown, certainly from what we've become accustomed to over the past decade or so.
Do your experts believe that's workable in terms of the totalitarian mandate to employ the masses? How do you do that with a 2 or 3% Chinese GDP? The math doesn't compute, does it?
Well, it's largely about the state-led model, really, and the inefficiencies that has driven, which suggests that, I mean, China's no longer the developing economy that it was. It no longer has. It's expanded into global markets. It's clearly done what it can in terms of exports and infrastructure. What you need at this stage is a shift towards the consumer, to a more kind of developed economy type standard model, and that's China's not moving that way at all. If anything, it's doubling down on its kind of state-led interventionist policies, which will be what lead growth to slow, alongside the demographics, which are just unavoidable.
What's the path for Germany to really climb out of this soft patch, potential recession that could last a bit, without China really picking up?
Yeah, I think to all intents and purposes, Germany is in a recession now, and that's likely to last for a couple more quarters, probably. I think the path for Germany to climb out ultimately will be policy easing by the ECB, but that's unlikely to come until well into next year, probably late next year. It doesn't stand to get that much support from China for sure, and car exports, although they've picked up quite a lot lately after this kind of dead cat bounce after the pandemic and the supply shortages around that kind of recovery is unlikely to be sustained. So what you'll need to look for is for the German consumer to start to spend again, and that's probably only going to come once we've got through this very, very difficult patch around policy tightening.
Jennifer, if this is a sort of recession that will continue, and we are seeing that weakness start to percolate out into even some of the economies that have gotten boosted by tourism in Europe and other industries, then are we going to see this actually cause inflation to come down? If it doesn't, what does that mean about both the ECB's role next week, but also going forward, what it will take to actually bring some price stability?
Yeah, I think it will bring inflation down. And I think already we've seen core inflation in the Eurozone coming off its peak. And there are various reasons to expect that to continue. Certainly on the goods side, it's very clear that the shortages that were driving up goods prices have eased off dramatically now. On services, we've still got further to go for sure. And in the Eurozone, you're not seeing the same signs of normalization in the labour market that you're seeing in the US so far. Labour market still looks very tight, and I think there's more upward pressure on wage growth to come. So it's going to be longer before the ECB can start to cut rates than it is for the US, we think, where core inflation is likely to fall much more sharply. But still, this recession will ease, resulting in easing in price pressures and in the labour market to some extent, which should allow the ECB to ultimately start easing policy. Next week's a very tough call. We're still going for a rate hike, although that's very much still in the balance. The minutes suggested that the ECB is now confident that it's seeing much more of that pass through.
Jen, quickly, we're out of time. Lucky for you. What's the animosity here between, if I have to pick, Germany and Portugal? What's the tension of this meeting next week between the centrist hawks and those more dovish?
Yeah, I think that there still is a tension, but with Germany in recession, that perhaps that tension isn't quite what it would otherwise be. Last night, the Dutch central bank governor was still saying that there's scope for another rate hike. So clearly there are still some hawks there that are looking for more, that are still concerned about wage growth, about inflation expectations. But yeah, it's clear that this tourism boost that we've seen in the south is going to fade, that those economies are going to start to struggle more. They're feeling the effects of interest rate hikes more quickly because of the structure of their mortgage markets. So yeah, we're going to continue to see that tension, which is, I think, one of the reasons why this call next week is a very close one.
Stagflation, TK, in Europe right now. The economy's stagnating.
Big time stag.
Got a big inflation problem. Tough call for the ECB next week. Jennifer, thank you. Jennifer Mikion there of Capital Economics. They acknowledged that in the account of their last meeting at the ECB, and I imagine that's going to be acknowledged publicly in the news conference by some journalists, maybe 2, 3, 4, 5, asking that question, hopefully, next week, Tom.
Is Germany in recession, or is it something different? When you have factory orders year over year, smart people say negative 4.5 and it comes in negative 10.5. That's not a miss.
So people who follow that data know that German factory orders can be incredibly volatile.
Okay.
A little bit dated as well. But it's hardly an isolated data point, is it?
No,
the data out of Germany has been pretty terrible.
I mean, it's hard for me to gauge it, but it's more than a mess that Lagarde has to deal with.
Without a doubt, that decision, a week today from New York City. This is Bloomberg.
The Fed would be very unwise to raise rates again just because of a short-term spike in enthusiasm in the service sector. I think there's still a window for a soft landing, but I think they should be very aware of the fact that there is a squeeze play going on consumers. You've now got these higher oil prices, higher gasoline prices, you've got a resumption of student loans, people are having to deal with these higher mortgage rates. and they're gradually pushing up their credit card balances. But there's a limit to that. So you're going to see consumer spending slow down.
You might call that a toxic brew. David Kelly there, Chief Global Strategist at JP Morgan
there you
Asset
go.
Management. Bramo, where did I get that from?
I have no idea.
Equities right now on the S&P 500, down about 1/3 of 1%. There is one story out there that I think is dominating things for the stock market yesterday and today. It's the move low we've seen in Apple. Softer yesterday, again this morning. The stock is down by close to 3% now. I'll offer you the reporting, and then I'll get you some south side, some bullish analysis from the permeable Dan Ives on Apple. I'm sure Dan won't mind being called that for this particular name. China plans to expand a ban on the US of iPhones in sensitive departments to government-backed agencies and state companies. This is a sign of growing challenges for Apple in its biggest foreign market, with about 1/5 of revenue coming out of China. Dan Ives writing this morning, just to give you a little bit of perspective on things, some context. On the recent China news over the last few days, we believe in a worst-case scenario, any China government agency iPhone ban is way overblown, as to quantify it's less than 500,000 iPhones of roughly 45 million we expect to be sold in China over the next 12 months. Now, they are the numbers, according to Dan Ives. I would raise this as a question, though, Tom. What about the signal that sends to the public in China as Apple unveils that new iPhone?
Well, yeah,
week?
I'd say that, but also what's the signal to Apple? I mean, you wonder when Apple really has to start making manufacturing decisions. They've done that tentatively. But my amateur take, this against off the world-class expertise of Mark Gurman, is it's been, it's sort of not clumsy, but it's just, we really like making phones in China, is sort of the feeling I get.
Well, and they have a good infrastructure to do so. But as John said, it's sort of at the heart of the G20 when you're looking at India and some of the manufacturing moving from China for Apple to India. I would just say on a larger scale issue, how much does this also indicate an acceleration of capital flows out of China? And this is what Damian Sassower was talking about. As investors say, if Apple, which employs millions of people, is going to be targeted by the government, who's next? Who's immune? Absolutely no one.
Who out of everyone handled the situation between US and China pretty well over the last few years. Just to put a price on Dan Ives and Wedbush, this is what they think. Outperform rating, 230 price target on the stock. Tom, they're calling the new unveiling of the new iPhone 15 a mini super cycle upgrade for Cupertino. That's the Dan Ives bullish view on this stock.
The smartest thing I've said when he was here last, I barely could handle it. He was dressed so much in yellow, my eyes were glazing
You're blinded
over,
by the clothes.
Blinded by Ives. But the smartest thing he said was, there's doubt whether the cell phone companies, John, will finance your overpriced purchase of the toy. And Ives really pushed against that and said AT&T, T-Mobile, and the rest, Verizon, will pony up again and subsidize.
We'll see. I'm with you, though, Tom.
To me,
Consumer
that's
price tolerance. My phone's doing all right. I don't feel the need to upgrade this anytime soon.
I have
really
the new
don't.
fancy
They
one.
gotta get on that.
And it's the battery.
Slow it down.
It's the battery.
Kill the battery, Bramo.
The battery on this
They
was
do.
game-changing.
I know.
They
I know.
do.
You were the one that told me, and I did research about it.
They do. They slowed
Okay.
yours down, Tom.
No, mine isn't slowed
okay.
down, but there's two in the family that have broken in the last couple days.
Right on cue.
Right on cue. Yeah,
Perfect timing.
We'll have to see how that goes as well. Let's do commodities right now. We can do this with a trillion expert. Away from just oil focus, Konahake is outstanding at ED and F man on the softs, on the agriculturals, and that. Kona, I'm really trying to cut back on my sugar consumption. I'm just thrilled with Tang Zero. It's really, really helped me out with less sugar involved, and yet sugar to the moon. Is there a global price for sugar? Should Americans be concerned about a surge in sugar in India?
Yeah, so we have the global sugar price that's actually reached 11-year highs. This happened yesterday. And it's because we're falling into deficit. This El Nino weather phenomenon that we've been seeing for the last 3-4 months really impacts the weather in Asia, particularly those cane growing regions in India and Thailand, who are major sugar cane exporters. They're suffering from declining yields, and the world's just going to have to live with a lot less exports out of these two key regions. So I think that's just suddenly tightened the supply-demand balance for global sugar, which has caused prices to surge higher.
Well, I look at the prices again, but I want to go back to what it means for Americans, because I think, all of us around the table, Lisa, less sugar, John, less sugar, even I'm trying to cut back sugar. That's sort of a zeitgeist out there right now in America. Are we going to adjust here because of higher sugar prices like we would to higher cattle prices?
Difficult to see how quickly the follow-through will be at the retail level. I think, obviously, because it's the futures price, there's going to be a time lag by the time the sugar buyers actually start passing that on at a supermarket level. So there will be some lag on that. Eventually, though, prices will probably have to rise higher. And then it's a question of, really, it's the income elasticity. How much do you actually consume sugar? Is it going to be high enough for you to actually reduce intake? I suspect that a lot of Americans probably don't consume as much sugar as maybe someone in Africa or Asia does, where sugar is a cheap calorie, which still compounds for quite a bit of your average diet. So I do think that in actual consumption, the trend has been falling definitely in developed countries because of obesity concerns, diet concerns. But in other parts of the world, I think sugar is still a very cheap source of calorie, where it's still very much part of the basket.
We weren't talking about sugar yesterday. We weren't talking about it the day before, even as it surged to 11-year highs. We were not talking about rice, even as it surged to 15-year highs. We were talking about oil, and we were wondering whether this was supply side or demand side, and whether this was something that was a broader indication of activity and demand, or whether this was something with Saudi Arabia sticking their thumb on the scales. Do you think there's something bigger going on throughout the commodity space with the price increases that we've seen in a vast number of specific sectors?
Yes, I think oil ultimately it's a linchpin. It's the driver of most commodities, and it's the biggest component in all the futures commodity indexes. So the fact that oil's reached $90 per barrel is significant, and it means that the whole commodity index pushes higher. For sugar, it does impact it because Brazil, which is the largest sugar producer in the world, has an optionality to produce ethanol or sugar, and ethanol is influenced by crude oil prices. So there is that linkage. But I think right now, today, the agricultural commodity sector is slightly diverged away from crude oil, only because we are looking at a weather market.
Yeah, but Kona, I just want to take this a step further, because let's say, just putting the agricultural side aside, there's a question about whether iron ore is sending the same signal that oil is, that something is maybe not as weak as people had previously expected, whether it's China or elsewhere, or if there is some other dynamic that could cause inflation to surge again in other areas. Do you think that that's a fair categorization?
I think one thing that is common to the whole commodity complex is the fact that China, which has been such a drag on the commodity sector for much of this year, is really talking up the amount of stimulation that the government's going to be putting in. So that in itself can provide some latent optimism that if China starts to stimulate its economy, there will be more demand for oil, agriculture, metals, you name it. So I think that could be definitely one potential. Otherwise, I think we're looking at pretty disparate little sectors, so ags, metals, and energy at this moment in time. And crude oil's rising only because of the OPEC cutback, because otherwise demand is not really shifted so much. I'd say the economic side for crude oil has been bearish to neutral, I'd say.
Kind of, we got to go. Thanks for the update. Kind of hack there of ED&F man. TK, I thought you were going to bring up the sugar lobby of the 1960s. Huge. United States.
Yeah, I didn't have time
it is the problem that. We should talk about that one day. Yeah. The fact that we still deal with the consequences of that decades later today. That people still view fat as the problem.
Yeah, it's not just bizarre. On sugar. It's on a lot of other products as well. I mean,
it's a cultural issue.
I didn't want to bring it up because Lisa's correct. We got to talk about oil at $90 Brent crude with Kona Hake. But I'm sorry, it's an important thing, and as she dials in, it's about obesity and all that. And all I can say is, in bonus round, Tang Zero is also gluten free.
Can I just say, John's just trying to wind me up because you know how I feel about this. I feel incredibly strongly about this, just like
Same
you.
Way,
yeah, exactly. In terms of if you want whole foods that don't have added sugar, that have whole fats, that's much better for you than fat free. and,
But how
tons
did
of
we
sugar.
get to this point?
Well, yeah, sugar lobby, go back
Being
to it.
poisoned in this country. And it's kind of bizarre.
Yeah,
and then
well-
this one guy becomes really wealthy investing in these companies that just go around poisoning
What book was that again?
people. Seema Shara, Principal Asset Management, up next.
We wonder if the consumer is beginning to bend, not necessarily break.
I think the last thing consumers need at this point in time is a spike in oil prices and gas prices.
Does energy drive the economy, or does the economy drive energy?
Oil prices going up, even for a short time, just complicates this narrative for the Fed.
Figuring out when to stop the rate hike cycle is always a really, really tricky business for central banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Attempting to avoid a third day of losses here on the S&P 500. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market's negative by 0.3% on the S&P 500. Apple down hard this morning, off by 3% TK after a softer session just yesterday.
Evolving, a lot of opinions on this, and I'd say a lot of unknown unknowns, as Dr. Alarian would say. We really don't know what the ramifications are. Certainly, you mentioned Mr. Ives with a bullish cast on Apple, says it's not that big a deal. But I agree, there's a lot of jury out. When there's jury out, the bid walks away, and that's what we've got.
That's what we've got right now, negative 2.9%. The headline from our story this morning, at least, China's seeking to broaden the iPhone ban to state firms and agencies following the Wall Street Journal report just yesterday. Dan Ives framing it nicely, drop in the ocean, just in terms of what this could account for overall sales in China. But for me, Lisa, it's about the optics, the signaling more broadly beyond that story.
And I think it is a bigger story beyond just Apple. Apple was the brightest light in China. They contributed millions of jobs, and yes, they had a huge amount of manufacturing there. They were thought to have a symbiotic relationship with the nation. If the nation is going to go after them, if the government is going to target them and try to call out their phones, is any investment safe? And what does this mean for capital flows? What does this mean for supply chains? And what does this mean to the cost of decoupling in a more meaningful way?
Well, and part of this is complications. In the opening there, Neela Richardson, always brilliant. She was great at Jackson Hole. And John, I love what she says about Apple, about China, about oil, this complicated September. I mean, it's just all of a sudden things are complicated, and all of a sudden there's Apple. Oops.
We talked about that toxic brew. Oil, you mentioned oil. Let's talk about that. Brent crude back to 90. So we've got crude at levels we haven't seen all year. Gasoline prices climbing. The resumption of student loan repayments. Retailers across America, from sporting retailers, Bramo,
really weak.
Walmart, Target, talking up the potential for weakness for the consumer as well. The problem we've all got with that, we've heard it a million times. And then you look at the ISM services number yesterday. If I just look at the ISM yesterday, no problem at all. Everything's okay.
Orders picking up, headline figure coming in above all expectations, even the price component ticking upward again for a second straight month. So not exactly giving that sense of gloom and doom. And then there was this from the Chicago Federal Reserve, a letter that came out yesterday saying that actually most of the effect of the rate hikes has already been transmitted, and that it looks very likely that we'll get back down to 2% by mid next year without a recession. So, seeing that this softness is a positive, it's a positive toxic brew.
That's the kind of thing you'd expect to hear from Goolsby, right? We're done here.
Well, I mean, that's sort of the theme, is that we're
Mission
done here.
complete.
That basically most of the transmission has gone through the economy. There's a little bit more. It'll be the perfect amount to calibrate down to 2%, and boom.
So easy, isn't it? Make it sound so easy. And then you've got Tony Dwyer saying it looks like a soft landing until it looks like a hard one. That was Tony, by the way, in the last hour on this program.
Yeah, Trooper, he came on. He's really sick. 4-week moving average on initial jobless claims, 237, which is not where it was. I mean, it was a lot lower back. I got it down to low of 190, 191, rounded up. A year ago, claims were 190, and now they've ballooned out to 237. Baloney, it's not enough to change
took
John
the
Williams.
chart out, remove the pandemic, like 230s, nothing.
Nothing's
Historically,
happened
it's just
here.
nothing.
How does John Williams with Mike McKee this afternoon address that? It's part of their dual mandate, and I guess we're employed.
The New York Fed president coming up a little bit later on this afternoon. I can confirm, Tom, you are employed. I am too. Bramo is as well. Hopefully it stays that way. TK. John Williams and a ton of Fed speakers.
Trying to get to Monday.
A little bit later. Let's get to the equity market right now on the S&P 500. Slightly negative. We're down 0.3%. Will we get day 3 for the S&P? 3 days of losses after a 2-day losing streak, amounting to a little more than 1%. In the bond market, yields lower by a single basis point. Lisa, the 10-year this morning, 426.59.
So we're going to be looking out for both things that you guys were talking about today. 8:30 a.m. We do get those initial jobless claims that Tom was mentioning that really have not gone up materially. When do we start to see the increase in unemployment, the increase in jobless claims that so many people have been expecting? Today, Fed speak galore. John was mentioning this. Let's give it to you. Philadelphia Fed's Patrick Harker, Chicago Fed President Austin Goolsbee, Atlanta Fed President Raphael Bostic, Fed Governor Michelle Bowman, Dallas Fed President Lori Logan. St. Louis is having a forum to try to pick their new Fed president and figure out the parameters for that. And Michael McKee in the spotlight figure, other than Tom Keene talking, will be John Williams of the New York Fed. That will be today at 3:35 p.m.
This is the strength of America. This is such an eclectic brew. And to be fair to the Bank of England, they even go with foreign members on the staff. But all those names you're mentioning, Lisa, they have all radically different backgrounds. I think it's pretty cool.
And they all will come out and say, we don't want to commit to anything and we have no guidance, but we're kind of going to try to signal hawkish maybe, but maybe also dovish. All right. And then we also get today President Biden leaving for the G20 meetings in New Delhi. Apple, sort of interesting. You were talking about this earlier. Are they front and center in these discussions as the U.S. tries to cozy up to India, especially as tensions continue to increase with Xi Jinping not attending this New Delhi summit?
Plenty of other little meetings to pay attention to, including the Saudis. And Alicia, you've mentioned that a couple of times in the last day or so. Looking forward to all of that. Joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, a line from Doug Cass moments ago. Why pay for Apple at 30 times earnings for slowing core growth? Now, Seema, it raises a question. Is this market expensive, or is it just a handful of names on the S&P 500 that are expensive?
That's a great question. Hi, John. Well, clearly we do know that those handful of companies are extraordinarily expensive. This is probably not the best time to be increasing your exposure to them. The market is looking pretty frothy. And then as you talk about the geopolitical tensions which continue to brew, maybe they do present some challenges ahead. And then if you look at the rest of the market, the rest of the market doesn't look that strong. I mean, you can see that some of the economic pressures, or at least concerns about potential economic pressures, are weighing on some company performances. Now, we could see that some of those valuations of those big tech names, as they start to be pressured, that's going to pull down the wider market. But ultimately, if we want to see a sustained, or if we will see a sustained drop in the market, it has to be driven by concerns about the economy, which, as you've said today, it's not so clear.
Seema, the heart of the matter, John Farrell mentioned this earlier, is stagflation is, I would suggest, a pretty wide outcome for a lot of our listeners and viewers. What if we get a true disinflationary trend based on tepid growth? All of a sudden, you got to model disinflation into the market. How do you accomplish that?
So, I mean, we are expecting the inflation numbers to continue to come down. We are also expecting the economy to slow down, which is what drives inflation lower. The idea is that, how much lower do they go? Do we go to the 2% level? What is the implication for the Fed policy beyond just the next 6 months of, are they going to hike again or not? It's really, that's the kind of the longer term question. Now, for us, I think it's actually a very difficult toss-up. The general thinking over the last 6, 7, 8 months has been actually that because of climate change, because of monetary policy, fiscal policy, you're going to have higher inflation out over the next 10 years. Actually, when you start to bring AI into the conversation, maybe that gets a little bit more dicey. So I think that conversation is still to be had if you're looking out over a 5-10 year horizon.
Just to bring these two conversations together, how much does this move against the iPhone really in China accelerate some of the decoupling and some of the deglobalization, some of the supply chain sort of redundancies that have to be built in that are going to cause inflation to remain higher? Are you rethinking any of your theses based on increasing tensions there?
Well, actually, I think the geopolitical tension discussion and what the impact on global growth is going to be has been around for so long. This isn't, we have seen repeated moves by both parties against technology firms. So this, again, isn't a new conversation. I think for Apple specifically, it's a couple of months of maybe a couple of days even of struggles. And then the market goes back to, responding and thinking about, well, what is the long-term productivity growth potential from Apple? And that's what drives the market. For the next 10 years, we do know, I think that's quite clear, that geopolitical tensions are only going to increase. The supply chains that we have been used to over the last 10 years, that is changing. We're thinking, all the new terms are coming up: friendshoring, nearshoring, ally shoring. These are all things that are going to continue to be perspectives which will put upward pressure on inflation. But I do think that has to be almost instantly offset by the idea that AI can put downward pressure on inflation as well.
So putting together what you're sort of seeing in terms of an investment thesis, does this mean that you're staying away from some of the big tech names just in the short run because of this lack of clarity, as John was asking about, in terms of valuation and what the forward look is, and going into bonds if you have conviction that inflation is going to come down?
So we have had an overweight to these large cap, mega cap tech companies. We are long-term believers in technology, and for us, that's a reason to stay overweight. Would we be looking to increase exposure at this point? No, because valuations are too extended, and we think there is a little bit of potential for a bit of a pullback. But the long-term perspective is important. Now, we also have a slight overweight on the duration side, so looking to increase our exposure to bonds because the expected drop in inflation driven by an expected weakening in the economy. So there are different levels within the asset allocation space. You said before, September, it's a tricky month. There is so many moving parts. There's so much data which is really contradicting each other that at this stage in time, I think cross-asset, we almost have to be neutral, and you're waiting for a clearer narrative to come through. But within the asset classes, I think you can take some longer-term perspectives which show up through within the portfolio positioning.
So what's your marginal allocation to the 7 or 8 big tech names? I think this is an arch issue.
We are overweight those big tech names.
Yeah, okay, you're overweight, so you're buying ever more of them?
Not at this stage. Not at this stage, because the market is looking so frothy. And as you said, the geopolitical tensions, maybe at this point in time, for the next couple of months, who knows, is going to be a little bit more pertinent. But as a long-term investor, I'm not going to reduce that exposure for this point in time. I think that mega cap tech will continue to deliver if you're looking out over a multi-year period.
Hey, Seema, thanks for being with us. Let's catch up in London in a couple of weeks. Seema Shah of Principal Asset Management. The word geopolitics often frustrates me sometimes. It's a word we throw around to mean whatever we want it to mean, and some we don't quantify it because we can't. That's when it comes to markets. I think this is fascinating going into the G20, what's happening with Apple here. Dan Ives of Wedbush, of course, taking the other side of the story. He's out on Twitter. Just a little bit more context of his views for you. Despite the loud noise, Apple has seen massive share gains in China. Smartphone market, we estimate that Cupertino has gained roughly 300 basis points of market share in the key China market over the last 18 months. He thinks the iPhone 15 is going to help out on that effort. And he finishes with this, Tom. The bark is worse than the bite, in our view.
Well, this is what you're going to hear, but you've also got a lot of people looking at single-digit revenue growth overall, including what we're going to see rejuvenated here on September 12th. And the answer is there's a whole body of people saying, you know what, it's a great company, but... And I think I sort of heard that from Ms. Shah as well.
That stock is down by 2.7%. Some timely conversations going into the G20 for you, happening right now live in Singapore. Canadian Prime Minister Justin Trudeau speaking at a Bloomberg New Economy series at an exclusive interview with our Eric Schatzker. Let's take a listen.
In constructive, productive ways. One of the things that Canadians deeply understand is the global economy is not a zero-sum game. It is not just possible, it is only optimal when everyone gets to draw benefits, whether it's on trade deals, whether it's on business deals. If you're in it for the short term, you can do win-lose. But if you want to create stability in a long-lasting way, you have to make people understand that we are all deeply invested in each other's success. And that's a bit of a shift from some of the ways we've seen the global economy acting over the past decades. But climate and pandemic and the need for more resilient, diversified supply chains is driving that. And being there to show up and continually make that case is the most important thing that we can do.
I can't think of a country in the world that doesn't want to get more out of its relationships in the Indo-Pacific region. You spoke of partners willing to engage. Which of the partners with whom you spoke, I presume in Jakarta, and will subsequently speak with in India, are most willing to engage? Which countries are stepping up?
I'm biased right now because I just came from Indonesia, but my conversations with President Widodo, with whom we'll be hopefully, but very much on track to sign a free trade deal within the next 12 months as a precursor to the free trade agreement that we're going to be signing with ASEAN, hopefully the year after. It's a lot for Mary to deliver on, but we're going to be able to do it because Canada has figured out, even this era of protectionism, how to get free trade deals done. And the key to that is, and it's certainly something that President Widodo understood and understands, trade, as you all know, creates growth. But it doesn't inherently make sure that that growth reaches everyone within communities and societies. And that's up to both policymakers and partners to make sure that people are feeling the benefits, because it goes to not just economic stability, but political and democratic and community security as well. So that pitch that we've continually made that trade can be about win-win, it can be about mutual benefits, flies in the face of the narratives that people are worried about around globalization over the past years, that demonstrates that, that we're able to engage. So I'm very bullish on Canada-Indonesia right now. But that might just be recency bias.
Mr. Prime Minister, how would you characterize Canada's relationship with China?
Obviously, we've had a challenging few years, as many people had. The arbitrary detention of 2 Canadians for political reasons put a real chill on the relationship. But China is one of the most important economies in the world and is not a country that anyone can simply ignore. We have to be eyes wide open as we engage. We have to look for where we're going to compete, where we're going to be very clear and contest based on our values, based on principles that Canadians expect us to adhere to. But we also need to look at where we actually can cooperate and work together. And one of the examples of that happened just last December, where Montreal hosted the Chinese COP15 on biodiversity. So Canada and China worked together to make sure that we came out of that COP15 on nature with incredibly ambitious targets of protecting 30% of the oceans and land on the planet by 2030. Now, that required us to work together and constructively, and on issues like climate, we are going to have to make sure we're working together.
So Canadian Prime Minister there, Justin Trudeau, speaking with Bloomberg in Singapore. You can continue watching that at Bloomberg.com and on YouTube. Bloomberg surveillance continues right now. TK, you'll recall that the Canadian Prime Minister was given a bit of a dressing down by the Chinese leader, President Xi. A diplomatic take there from the Canadian Prime Minister.
We're making the Pacific Rim circle right now. We've got to remember this within G7 and frankly in G20 is his closest approximation to a royal family that we have. He was 28 when his father died. This is a kid who in the nursery was handled by Richard Nixon. Pat Nixon brought him a Snoopy dog as a newborn. I mean, this is something, this guy was born to do this. And yet, Lisa, I've got Tristan Hopper in the National Post of Toronto, first reading, why Trudeau isn't resigning. He's getting clobbered in Canada by all sides, so why not go to the Pacific Rim?
Okay, there is that suggestion that maybe he's just trying to avoid the domestic politics.
Yeah.
On a broader level, there is a real awkwardness when the question of what's your relationship like with China, and I think that that's going to permeate all of the G20 conversation. What is your relationship with China? What is your relationship? Who's your alliance? Is it going to be the U.S. or is it going to be over on the Eastern Hemisphere?
If you're Europe, can you sit on the fence, Tom? That's the question. They've been sitting on the fence for a long time. How sustainable is that position now?
Yeah, I strongly agree with that Europe here with China is a major focus, and particularly with Huawei. It'll be interesting to, the fears that Americans seem to have on a bipartisan basis. I do agree that Europe is the tip point as well, but most of it's domestically China. I would suggest just domestically China. Right now, we're going to get a brief on this, so we can make it up as we go with Anne-Marie Horder, Bloomberg Canadian correspondent who joins us now. Anne-Marie, we just heard from the Prime Minister of Canada there. What is our relationship in Washington with Canada? I recall that President Trump had a tariff battle over lumber and such. Chrystia Friedland was going back and forth on that. What is the present relationship with Canada and the Biden administration?
Well, I think throughout history, even if there is arguments between Canada and the United States, that there is still friendly relationships, right? It's the United States' biggest land border. And this administration particularly does have a good relationship when it comes to Justin Trudeau and his team. A lot of that has to do with what they're doing in the Asia Pacific. You know, I've spoken a number of times with Canada's trade minister and the work that they are trying to put into what is going on in the Asia Pacific, trying to diversify supply chains. So they do see eye to eye in that. They also, saw eye to eye in potentially what was going on and what they deemed as nationalist protocols when it comes to Mexico and some of their industrial policies. So I would say this administration has a good relationship with Canada, and they do seem to see eye to eye. And the United States almost sometimes feels like they're bringing Canada along in some of these discussions. But I would say it's a healthy relationship. And even if there's frictions in the past, for the most part, it usually is.
Let's segue here to the domestic front, Anne-Marie, as only you can do on balance of power. Help me with the president's relationship with what he believes is his core constituency, unions. Give us an update here as we stagger to Ford Motor and maybe next week a strike.
Well, yesterday he had the unions for the longshoremen, the individuals that work at the warehouse in the Pacific Rim and these ports celebrating this deal they were able to ink. It's going to be more challenging when you look at the auto workers. We are coming up very close, that September 14th deadline when that contract ends. What we do know is that the UAW was supposed to send back a counterproposal to Ford yesterday. It does seem that they are more ahead when it comes to negotiating with Ford than they are with GM and Stellantis. Maybe GM a little bit more friendlier than Stellantis. I think there's a lot more work to do. But when Sean Fain has been asked, will you strike if you don't get a deal that you deem appropriate, he said yes. So they are preparing for that in terms of the unions. And it's going to be, as we've said a number of times, very difficult for this president. He does not want to see auto workers on strike. First off, that could be incredibly difficult for the economy, as well as the fact that there are lower supplies of vehicles at the moment. But at the same time, he wants to make sure he is standing behind these workers. He wants their vote. He has said time and time again, his almost most used phrase is, I'm going to be the most pro-union president in modern history. So that's going to be on display next week.
And Maria, I apologize in advance for playing a bit of topic roulette, but just shifting from what we're speaking about with unions. So going forward, though, with respect to China, I am curious about how much the whole move with Apple ups the ante. There's also there are headlines coming out about potential additional steel tariffs from the U.S. and Europe on China. There's discussion about whether this reignites TikTok bans. How much is that discussion kind of getting reignited by some of the moves by China that we've seen over the past few weeks?
Well, I think this will be the elephant in the room at the G20. I mean, China, Xi Jinping, he is not going to represent China. He's sending someone else, a deputy. And so what you have here is the United States is really going to be trying to, with hard and soft power, explain to the other members of the G20 why they should be looking to the United States and not be looking to Beijing. One big topic, of course, is going to be how the U.S. administration really wants to bolster the World Bank instead of countries looking to Belt and Road for initiatives. And Xi Jinping will not be there. The issue is, of course, is that a lot of countries, like the United States, have tremendous amount of commercial ties with China. And similar to Biden's difficult line he has to walk when it comes to the union, it's also a difficult line he has to walk with Beijing. There is still potential that Biden would sit down with Xi Jinping at the APEC summit in San Francisco before the year is up. That is happening in November. But how much can you do that and maintain a dialogue if you are poking the bear? The issue is, of course, when it comes to China, with things like the government saying they're potentially not going to let you use iPhones. It's similar to the way the United States said if you have a government phone, you can't have TikTok. Huawei comes out with a new phone. How did they get there? Representative Michael McCall is saying it looks like they potentially usurped sanctions. This means there's going to be a lot more pressure on this administration to maybe not take that narrow approach on national security when it comes to sanctions and export controls on China.
When I think about balancing the business interest with some of the political concerns with respect to the U.S.-China relationship, I think of Janet Yellen, who has often come out more on the pro-business side of things, trying to encourage the relationship, saying they cannot decouple from themselves, China and the U.S. Where is the mindset of the White House? Where is the balance of power in discussing business interests versus the political will to decouple more aggressively?
Well, Lisa, there's one thing this administration has wanted to make clear. It is not decoupling, it is de-risking. And still people maintain that they don't really understand the difference between the two. While you are correct, Secretary Janet Yellen of the Treasury really has been seen as a pro-trade individual when it comes to her past work as an economist. She did give this landmark speech, though, when she was talking about China this year, and she said, above all, national security is paramount to any kind of business we can do. So it's a similar message we heard from Gina Raimondo, who was the last of the cabinet officials to just visit China. And she said, we can have a bedrock of commercial ties to really ignite this relationship, revamp this relationship, but we will never walk away from our national security concerns. And that really seems to be the tone this administration wants to take.
MH, thank you. Anne-Marie, on the latest going into the G20 later this weekend. A bit of tension, Tom, over the last year or so between the State Department and Treasury on some of those issues.
You nailed it. And Anne-Marie, of course, always nails it. All this is U.S. officials, and I go back to the initial effort by Hank Paulson, as Secretary of Treasury, to go over there and actually jumpstart something in a honest China-U.S. dialogue. From what I can tell, they're just flying over to China to play to the American press. I mean, help me here.
I've talked about that a million times.
I just
follow actions.
Anne-Marie nailed it.
Not optics and rhetoric.
Optics, yes.
From New York City this morning, good morning. Equity futures near session lows. We're down here by 0.4% on the S&P 500. Yields down by almost a basis point on a 10-year. This is Bloomberg. We've talked a million times about Bramo Cam. We need Bramo Mike in the commercial break.
I go big little. I do like the sports.
Honestly.
Come on, Mina Kimes just signed her ginormous deal with ESPN. Congratulations to Mina Kimes for that. She can be like Mina Kimes in finance, where you do big little, and
Bramo
she's
Unplugged.
going mental there.
Lisa Unplugged.
The break.
Yeah, that works for me. That works for me. I'll move on for you, Lisa.
Thank you.
Equities on the S&P, negative here by 0.4% on the S&P 500. It's a pullback, a little softer. We're down by 0.8% now on the NASDAQ. We've got to keep one eye on Apple all morning. Their stock is down by 2.8%. So some real weakness in tech. Yesterday, some weakness in Apple again this morning. A potential that maybe that ban for the iPhone spreads at the Chinese state level, Tom, to other agencies, to state firms. This is going to become a bigger and bigger story going into next week when we get the new unveiling of the new iPhone, Tom, the iPhone 15.
You wonder if they'll break protocol and come out before earnings and make some form of statement. Moments ago, the first publishing the 10-year real yield this morning unched 1.97%, and I would suggest that folds into big tech, and then they have to deal now with a substantial real yield.
Let's turn to fixed income. 2-year, 10-year, 30-year. 10-year looks like this. Your yield, 426.98. Let's call that 427.18 now. Just turning back up to 427. Yields higher for 3 consecutive days. Yields up for 3 straight sessions, and not a million miles away of the cycle high from a few weeks ago of 436 on a 10-year. A 2-year yesterday, for what it's worth, closing above 5%. The 2-year this morning down a couple of basis points to 499.30. And I talked about that tension in the market, particularly at the front end in yesterday's session. The beige book said a little bit of weakness, maybe even a soft landing, a slowdown perhaps, raising those kind of questions, those themes. Then the ISM was just like, yeah, what slowdown? And then that's when you saw that yield move, Lisa, at the front end.
What's interesting to me is what data the market responded to. And does this mean that the market has more confidence in the ISM figures? Or does it mean that there is a bias already baked into markets looking for a stronger than expected economy, leaving rates higher for longer? A consensus shifting more to the Jim Bianco point of view rather than the Bob Michaels point of view?
We're drowning in ambiguities right now. I think I love what Naylor Richardson said as we opened this hour. I guess you had her on yesterday. And the basic idea here...
Thanks for following the show yesterday.
Yeah, I did. I was on top.
Appreciate that. That's
I'm watching
good.
on my phone
That's
outside. I'm outside school and they're talking about Ferro. I mean, they don't talk about me or you, Bramo. They're talking about
It's
Ferro.
okay.
They're
I'm okay
like,
with this. The high
John
school?
Ferro
I'm
got
fine
us
with
through
that.
the summer. And I'm like, what? I didn't get you through the summer? Lisa didn't get you through the summer? Wait, Lisa wasn't here.
Are you talking about yourself? You weren't here.
Well, I had some illness there, you know.
That's true. That's true.
It was
Still recovering.
you know.
We'll give you a break.
Yeah,
Let's turn to foreign exchange
Tang's
just
good
briefly.
here.
Let's get
Foreign
that euro
exchange,
up.
please.
The euro clinging at 107.
Clinging.
107.07 and breaking down. We're down by 0.2% on that currency pair. The latest data, the GDP, I think put it this way, there is barely any growth, if any, in Europe right now at a time where inflation is still elevated. The ECB is trying to do what it's got to do. And Tom, this for me, I talked to Guy Johnson about this a number of weeks ago. This is really important stuff here in the United States. So here we have an economy, a case study. They've already got the damage done to growth, but they haven't got inflation anywhere near back to target.
But
what's happening in
my
Europe?
textbooks, which I guess aren't valid anymore, is if you do get growth slow down, somehow you get disinflation. And I would really love to hear what John Williams says about that today with Michael McKee.
What's the lag? I guess we'll find out from President Lagarde and we'll get her view a week today. Crude, by the way, for what it's worth, still Brent, $90 a barrel. WTI just about unchanged today at 87. Let me bring you the data wrap. Under surveillance this morning, China's trade slump easing, but still in contraction. Exports falling nearly 9%, with imports sliding just over 7% last month. However, in that data, demand for commodities surging. Lisa, for the likes of coal, crude, copper and iron ore. And that supports arguably what we're seeing in the market for iron ore and crude right now.
So China may be slowly decoupling from the U.S., but still having more strength than some people are giving credit to. And I think Leland Miller was pointing to that. It might be more domestically focused, but it is bleeding out into certain commodity markets that we keep talking about that might fly in the face of China's falling off a cliff kind of narrative.
Nailed it. And I would say for all of our listeners and viewers, get your radar up, because people are conflating their domestic balance sheet challenges, some of the COVID demographics and that, with their foreign economic dynamics. Baloney. It's not the case. You know, somebody said earlier 2-3%. Do they come in at 4 or 5%? I don't know, but there's a school of thought on that.
That's the data out of China. The data out of Germany, off the back of that weak demand in China, looks like this. Another disappointing note for Germany, with industrial output falling again for the month of July. Meanwhile, Eurozone GDP barely growing with a read of 0.1%. for the second quarter. Looking ahead to the data stateside, jobless claims a little bit later this morning, just under an hour away. A slew of Fed speakers going to respond to some of this. Lisa went through it earlier. It's worth going through it again. Harker, Goolsbee, Bostic, Bowman, Logan, all ahead of the quiet period. Plus this one. This is the big one. Mike McKee sitting down with the New York Fed President John Williams, 3:35 Eastern Time. So a little bit later on, Tom, this afternoon. That one in focus, I think, for all of us a little bit later.
Who is this guy? For those of you not keeping score between Goolsbee and Williams, this is the monetary theorist with Mr. Laubach. He came up with R-starred, which is a double plug-in idea of what's the most optimal place to be for growth given inflation. And the answer, as John Williams suggests, we will migrate back to a pre-COVID lower R-starred. Many others disagree.
Is there some tension with Chairman Powell on that? Talk about the core of the Fed, that three, the vice chair, the chair, New York Fed president. Chairman Powell doesn't want to engage in that conversation at all based on what he said in Jackson Hole.
He's like me. Jerome Powell can't do the math. Christine Lagarde can't do the math. Tom Keene can't do the math.
Hey, John Farrell can't do the math either.
Powell's going to listen to the people he has that do the math to find out if 2.0% is a new 2.x% is Clarida, who can do the math, would suggest.
John Williams, a little bit later on, Tom, this afternoon with Mike McKee.
Yeah, looking forward to that. It'll be interesting to see. Let's get a brief now on the global economy and also on the American economy with T. Rowe Price. Blarina Yarucci joins us right now. Blarina, you got a single sentence that's absolutely really harkens to our conversation with David Folkerts Landau in London here in about 10 days. And Blarina, it's real simple. You see growth resilience with fiscal support to the rescue. Where's the fiscal support going to come from?
It's so interesting because when we've looked at the traditional measures of fiscal impulse, the declining deficit, the declining government spending growth, everything has pointed to fiscal not really being a tailwind to the economy. But actually, you have to dig deep and look at how the Inflation Reduction Act and CHIPS is funneling into the manufacturing sector and driving manufacturing construction at a time when residential investment is collapsing And you need to look at how small business balance sheets are being boosted by the employment retention credit. And all that, I think, are providing another lifeline to the economy at a time when interest rates are increasing significantly.
Well, let's cut to the chase. Sebastian Page of T. Rowe Price would be rude. He'd be in the meeting and go, Blarina, don't give me the concept. What's real GDP going to be? We're not going to sustain 6% real GDP. But what level are we going to sustain if we get a buoyant fiscal support?
You know, we think about potential GDP in the U.S. at somewhere between 1.5% and 2%. And the truth is the second half of the year is shaping up to be again above potential. And we have an unemployment rate that is at historical lows. And the recent increase in the payroll data for August was driven by increasing participation rates, not because we're laying off workers in large scale. I mean, that points to a resilient economy.
A Chicago Fed paper came out and said that, yes, the economy was resilient, but it is slowing, and it has basically felt most of the impact from the 5.25% increase in rates, or 5.5. So that is sort of the level that we're at. Do you agree with this? They also are seeing inflation coming down to 2% by mid-next year and us avoiding a recession.
I think this is a very difficult question for all of us. The truth is we've all been looking for a recession because of the speed at which interest rates have been increasing. But what's different in this cycle is the health of the balance sheet of the corporate sector and the consumer sector, is the fact that a lot of the debt in the US was locked in at the old lower interest rates, which means we should be looking for the lags of monetary policy transmission into the indebted sectors of the economy to be longer. I get it that policy transmission is faster through this forward guidance and financial conditions channel. But the fact is, when debt is fixed, then that makes the economy not as sensitive to interest rate increases. So I'm not sure that we've seen all the pain that this increase in interest rates will cause to the economy yet.
How difficult is it to parse out the interest rate implications for the economy at a time of such geopolitical tumult, where there's a question about where investment is coming from, whether China is still buying treasuries at the same pace or investing in the U.S., what's happening with German manufacturing, and then at the heart of it, how isolated the U.S. really is in its strength that it can keep going regardless of all of these headwinds?
As you said, Lisa, there is a lot of realignment going on in trade channels. We have the friendshoring and reshoring. We have these protectionist measures that are being announced at the margins. You don't have to announce tariffs to announce protectionism. You can target specific industries or specific companies. We know what this does is to decrease efficiencies in global trade, economic efficiencies. It reduces productivity. And what does it do to cost of production? So it's very interesting trying to bring all of this in and thinking, what is the medium and longer term inflation outlook?
Blarina, one final question. Let me segue here over to housing. Are we going to get housing disinflation? I believe they have that in the United Kingdom. Are we actually going to disinflate home prices?
That was widely expected for this year, and it's been a surprise that we haven't had that. For me, the key is the demand-supply imbalance in the U.S. We've had a chronic under-construction post-GFC, and you look at the inventory for existing home sales, especially, it's pretty low. And then you have the mortgage lock. Why would you move right now when you've locked your mortgage at 3% and new mortgage rates are 7%? So I don't think the risks of disinflation in the housing market are as high as they are in the UK. Very different housing markets, very different mortgage systems.
The pass-through just so much faster.
Can tell you.
So much faster, Blarina, I know. It's just ridiculous. The differences are huge.
The differences are huge. You've been, frankly, with all the American press, John, I think you've really led on this. What I would suggest in the reading I've done over the last number of days, including yesterday when I was off, I read a lot on multifamily housing.
What did you learn?
I learned that America has a corporate investment in multifamily housing, and they've gone full animal, and it's like way overbuilt, and they look for rental compression throughout, not greater New York, because we don't do multifamily housing, but across this nation, rents will come down.
pushback's going to be huge in the next 12 months going into the election. Blarina, thank you. Blarina Yurichi there of T. Rowe Price. If you are just tuning in, welcome. Your equity market on the S&P 500 negative by 0.4%. Now, if you tried to watch the US Open in America and you have Spectrum, you've probably struggled to do that because ESPN, the Walt Disney Company, are having a little bit of a battle about all of that, TK. We're going to have a chat with Michael Nathanson a little bit later this morning in about 5 minutes' time.
And again, this goes to the heart of the matter, which Moffat and Nathanson have nailed, which is cord cutting. I mean, the world has changed, and we've been waiting and waiting and waiting and waiting, and it's now the time. I just look like everybody else at the action that I see at home. Cable's dead. That's my summary.
Sign up to Hulu is the message from Disney. Maybe, and then you get ESPN.
What do you think? You use
watch.
Hulu. I don't use Hulu.
I get Hulu. I have ESPN as a part of that, Disney Plus as well. It's getting more and more expensive. The first time I got that, Tom, it was
like they gave it to you. Yeah.
Way cheaper. And now it's pretty pricey. Throw in broadband and you've got a pretty expensive monthly bill there.
Well, I just think it all lies with sports, and that I think is what was really coming to the fore. And then whoever wins the sports and sort of the key teams, the key Lionel Messi's of the world is going to win, and that seems to be the key.
I watch Formula One on the Formula One app, which is British announcers, Sky TV, I believe. I don't watch it on ESPN or that.
That's interesting. I watch it through ESPN.
I don't. I just don't.
What are you watching it on?
I'm watching it on an app called Formula One, where everybody looks like you. They're all out there on the track beforehand. And,
what do you mean they look like? What does that mean?
More details.
They're like European and cut and chisel. They're wearing Moncler and Celine and all that, and they're like Monza skinny tie, and they're all hanging out going,
on the grid.
You know, max, max, max. And they have little blankets over the tires.
Is that what we sound like? Max, max, max.
Yes, they have blankets over the tires.
Please, I might not be back.
If you look through a variety of earnings calls, companies saying consumers are becoming more cost conscious. They are pushing back. They are adapting to this intense price environment around them. So I would say expect some moderation. You know, from my seat, I wouldn't see that as reason to panic, though. I see that as evidence of rationality.
The brilliant Laurie Calvasina, head of US equity strategy at RBC Capital Markets. Welcome to the program. Your equity market session lows on the S&P 500, potentially a third day of losses. We're down here by 0.4%. Our next story, this one right here, a contract dispute between Disney and cable TV provider Charter Communications, leaving millions without ESPN, just as the NFL football season kicks off tonight and as the US Open is ongoing. Now, both companies steering customers to online services, Disney running ads to subscribe to Hulu Plus Live TV, its own cable alternative. Meanwhile, Charter urging customers to sign up for rival Fubo TV. TK, I'm not sure anyone wins when stuff like this happens.
Well, who wins is, I guess, the theory was the customer wins. But people like John Ferro, who have to see the tots on the weekend, have 17 different things. So, John, we've all failed at this because we've all added back to what was a cable TV bill of years ago.
The bundle's back.
The bundle's back.
The bundle's back. It's so expensive now, it's ridiculous.
And, you know, we're going to get to Michael Nathanson here in the morning, but just one more comment on this. This time does seem different. I mean, Charter has said enough. I don't know what that means, but, you know, that's where we are.
Oh, you don't think they're going to sort this out?
I don't know. Okay. They always do at the nth hour. Someone who keeps track of the nth hour. We're going to get to this right now. It's so important. Michael Nathanson joins us, senior research analyst, SVB Moffat Nathanson. Michael, you guys absolutely nailed cord cutting. Where are we in the continuum? If you were talking to Charter management today, how much worse is this going to get for the Charters of the world?
Yeah, good morning. It's an interesting question. Craig Moffat, who covers Charter, would say, look, Charter is becoming indifferent to being in the video business, right? So it's not the business it was a decade ago. But going forward, they're saying to us, we don't really need to be in this business anymore. It's a low margin business. Broadband and mobile phone is our future. If you keep pushing rates as high as you are, Mr. ESPN, we can't afford to actually service this business anymore. So it's bad enough for them to walk away from video, which is a shocking statement given that they have the more video customers than anyone in this country right now.
Michael, how do you think this gets resolved, this current spat? What do you think the end game looks like?
John, I would have thought it'd be resolved by today, right? I think this goes into another weekend. the end game, if it's not resolved by Monday Night Football, Bills, Jets, I think what happens is that Disney will be dropped, ESPN will be dropped from Charter systems, and that Disney will have to work extra hard to convince people who are in Charter to take either Hulu or YouTube TV, right? So I think, if this is not resolved by this weekend, it's a huge problem. The problem here is that Charter wants the apps that Disney is selling to its own customers given for free to Charter's customers, right? So we all complain about the billing and the double, the expenses of now building a new bundle. They want to give that bundle back for free, the streaming bundle, to their customers. And that is a non-starter, right? So the ask is so wide from what actually Disney can do. So we're not very hopeful this can be resolved.
Pretty embarrassing at the moment, Michael, given that we've got tennis players in news conferences at the US Open saying they can't watch the tennis themselves from their hotel rooms. Now, when we think about losers, I'm thinking first and foremost of the consumer, the customer who can't watch the sport they'd like to watch right now without paying up for alternatives. Michael, who is the big loser out of these two sides in this conflict currently?
The big losers are both. I would say to you, the bigger loser in the long term, if this is not resolved, is Disney, because this will become standard operating procedure across the industry, right? So Disney, which has a ton of fixed sports contracts, will lose distribution and carriage across the pay TV world, right? So that is untenable. It's unthinkable a week ago. Charter and the rest of the video business will say to you, look, we're indifferent. We've seen other cable operators de-emphasize video. So the bigger losers, so John, play it forward too, will be sports leagues, right? All the leagues and all the players who have counted on TV inflation to pay their salaries, that's going to be a huge challenge going forward, right? So this is the beginning of a multi-layer problem for a ton of industries that that no one's thinking about right now.
Michael, does it really point to a new model for both sports and for streaming? And it's a model really pioneered by, or perhaps exemplified by Lionel Messi and what he's doing with Apple Plus, given the fact that he is getting a chunk of that. There's the revenue, there's the upside. And oh yeah, Apple Plus signups have been through the roof in response to his celebrity. Is this the new model and the winning model that you foresee going forward?
See, Lisa, I would have said to you, the new model is the old model. The old model will work well, right? Which is you had one place, one bundle, one linear bundle where all your sports were available, right? And for the life of us, we don't understand why the industries, both media and distribution, have not worked to make a skinnier bundle of sports. John talks about, Peacock and Premier League. That content should be in the bundle. When the U.S. Open's playing the first couple rounds of golf, I want to see it on ESPN. The problem is that the two sides have not come together to create a new bundle, and thus all the rights are fragmented. Mm-hmm. So I am very fearful of the consumer experience going forward if it's not solved. It is suboptimal, as you guys have joked about, to watch 17 different sports apps to watch your team. Yeah. And they're killing what was the golden goose. And it drives us crazy that people want to build over-the-top sports apps when the model worked in the old bundle. That was the best way to get sports. It was all there.
Yeah. Michael Nathanson, buy, hold, sell. Disney I've enjoyed from 189. Loaded the boat on my trip to Disneyland in Anaheim. 189, and we're enjoying it at 81. You got a rebound to 115 and an outperform. Justify your outperform.
Yeah, so we upgraded it when Bob Iger came back at 90. We're down, 10%. The call here is that their streaming business should be a lot more profitable than it appears today. When they buy in Hulu, which is probably going to happen by the end of the year now, we think there's a lot more margin opportunity at streaming. Plus, the park business is close to where the stock value is today. So our call is you're buying the stock with parks fully valued and an option on streaming profitability. Their margins are -10. Netflix margins are 20%. So we think that's the big difference. The bundle, really, this is a lot of noise. It doesn't matter that much in the long term because the market puts so little value on linear assets, right? Look at where Paramount trades or Warner Brothers trades. They're lowly valued companies, and that's not the call of Disney. It's parks plus streaming.
Yeah, Michael, quick here because John wants to get in. If you have that where it's a parks with a bolt-on streaming for free, great. Can you generate a free cash flow out of the parks business to support the dividend, support use of cash inside?
You will, it's a great question. The company used to make $10 billion of free cash flow. They make $4 billion today. $4 billion is largely parked. So you would say $4 billion is your support for cash flow, for dividends, for a buyback. It'll be a lower cash flow business, but it'll be a higher multiple business. And, Tom, there are media companies that have 20% cash flow yields that no one cares about today, right? So we're looking at cash flow yields just explode and no one cares because the sustainability, as you guys have asked this morning, is certainly in question.
Michael, I can't think of a CEO that is more loved, despite the fact the stock's not doing well. Goldman is down 6% year to date. Solomon gets a ton of bad press. Disney's down about 6% year to date. Bob Iger still gets all this media love. Michael, where does that media love come from? Is he doing a good job? These problems were all blamed on Chapek, who was in the job for 5 minutes. When does Bob Iger start to own some of these issues?
I think, our call on this is give Bob the 2024, right? You're turning a battleship around. The real issue in our view was, John, we could spend another hour on Disney. Chapek overspent on streaming. He basically was chasing subscribers, not profitability. It takes time to turn that around. They have to buy in Hulu. But I think what we would say, and I think it's fair criticism, is that the communication out of Disney since Bob has come back has been very poor, right? They basically have thrown out a ton of ideas and they've teased the market without delivering on what the story actually is going to be. Truth be told, the stock is trading where it is and there's very little long-only support right now, right? So I think the market has voted. And our call is, look, this is about 2024 fixing businesses that should be more profitable. But John, it's a fair comment. This ESPN issue, a lot of it was built on Bob talking about what he was going to do in the future, because Disney's not been aggressively leaking their content into streaming, ESPN anyway. But he's been talking about, we're going to do this at some point. And I think Charter's management's, look, if you're going to do this, why are we paying for ESPN today?
I could do this for another hour too, Michael. I'm just been screamed at because I've got 5 seconds left on the clock.
Exactly.
Michael, thank you, buddy. Michael Nathanson of SVB Moffett-Nathanson.
We are seeing the turning point in global monetary policy.
We're staring down the barrel of what's probably a sluggish economy for quite some time.
The consumer really has taken on a lot this year.
You're seeing investors begin to entertain the idea that maybe a soft landing isn't a guarantee.
The Fed's job now is much more complicated.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene all together again. How exciting. NASDAQ heading for a negative 1% to start the morning. A little bit moldy. Huge international news flow. We'll get to that. And John, in this hour on a fully employed America, maybe claims.
Yeah, a bit of tension in the economic data, some conflict, I think, between the Beige Book, which signalled a slowdown, maybe even a soft landing. You don't read it. Lisa did, I did too. And compare that with the ISM that came out yesterday, which was kind of boomy, pretty decent, quite strong. That pushed yields higher at the front end, the 2-year back above 5% on a 2-year yield, Tom, going into the Fed in a couple of weeks' time, which seemingly, at the moment at least, rate hikes are on ice.
Right now, we're Warren Buffetted by all sorts of international ideas here. You mentioned Germany flat on their back. We've got the Apple story we've been looking at all morning in China. But John, to me, Neela Richardson mentioning the complexities out there, I'm benumbed by it. I'm sort of surprised equities have held up a VIX of exactly 15.00.
Bit of a struggle this morning. You mentioned Apple. We should talk about it. Let's sit on that for a moment. The stock is down by about 2% this morning, trying to come back on my screen at the moment, down a little more than 1%, dancing around.
It's a correction.
TK, at the end of the day, it's a bit of weakness off the back of what may or may not happen in China. At the moment, what we do know, based on reporting from the Journal yesterday, from our team this morning, is that this ban at the state level is spreading from agency to agency and potentially to state firms as well. This is an important region for them. About a fifth of revenue comes from China, TK. Of course, for government iPhones, that's just a drop in the ocean. Dan Ives of Wedbush has talked about that. But as Lisa has mentioned, Tom, it's about the signaling, the optics, going into this launch next week for the iPhone 15.
But if you've bought back 120% of the stock over the last decade, as Apple does, I mean, this is an opportunity on a negative 10% correction, Lisa, to come in and buy back shares. I mean, that's a belief that Apple will do that among the Apple bulls.
You've been reading Dan Ives, and I think that he'd probably very much agree with you, and he would say, let's
He
go.
won't show me his research.
But then here is this sort of existential risk of, so it's a small drop in the bucket when it comes to government phones, but what does it mean when it comes to where Apple is going to try to do more of its manufacturing, how much it tries to immunize itself from China, what it means in terms of just broader decoupling, and what it means in terms of the growth trajectory for a company that got an upside surprise from their China business in the previous earnings report. It's important to keep noting that has been a point of strength for them.
In all that we've talked about this morning, and thank you for your emails, your tweets, the love you give John. I get nothing. But, John, I look at this and I'm sorry, I'm waiting for the inflation reports in various countries, Germany included, Europe, I'm waiting.
13th
I'm waiting
for the US.
for the U.S. inflation report because maybe that's all that matters.
Elephant in the room. Shall I whisper it?
Yes.
$90 crude.
Don't tell the guard. Yeah.
$90 crude.
That helps.
$90 Brent. That's the
Gas
elephant in the room.
gallon
Right
of
now.
gas
Just for
has
anyone at home who didn't hear me whispering. I don't think you heard me either.
No, this mic doesn't work.
Yeah, $90 crude, Tom. That's the elephant in the room right now.
Yeah, it is. I mean, that's where we are. Let me do the data check, and I'm going to go right back to that. Brent crude, 90.14. And, John, the 10-year real yield, 1.96%, elevated.
Nominal yield down about a basis point, TK. Let's call this 427, 426.98 in the FX market. More dollar strength. I've said it all morning. The euro clinging to 107. More weak data out of Europe right now at 107.06. Have we got some headlines on Ford? I think we have. Offering further improvements in the next contract. Nearly 8,000 UAW represented employees received a raise. UAW represented employees received a raise on Labor Day. Lisa, is it sufficient? Based on what we were talking about earlier this morning, the offer was 9%. They were looking for 40. Have we got a resolution?
Well, they are putting out the proposal, and we will see whether it is accepted by the UAW. What I'm interested in seeing is whether this provides the template for other auto manufacturers in Detroit. But this really is the question, especially ahead of, I believe, next week, the strike will go into effect if they don't come to some sort of resolution.
They have fast-tracked a pay boost, Tom, for 8,000 UAW employees over at Ford.
I don't know what to make of it, to be honest. I mean, this to me it's like the Disney charter thing. It's hardball in a time of huge stress. What's the stress? Rates have changed. The real yield is real. And that's a change. And as Jeff Curry at Goldman Sachs suggests, it permeates energy. It permeates every other sector, including labor cost at big, complex companies.
Are these the dying fuse, dying embers of labour market power, or the start of something
Don't know.
stickier?
I think what
Ford, UPS,
we've got a
the
yield
airlines.
structure back to 2006, and all of a sudden it's a new thing for everybody, including labor.
Yeah, going into 24.
Let's say this. We've got a very important guest here. Stop if you are in the stock market. For Anastasia Amoroso, Chief Investment Strategist at iCapital. Her deceptive charm is she says exactly what she thinks in her notes. It's lost in translation sometimes, but there it is, a single sentence. It's what everyone wants to talk about. You say, buy the dip in tech AI. Discuss.
Tom, this time I put it at the top of the note to make sure it didn't get lost at the bottom.
I only read the first paragraph of your notes. That's the words that
So I use as a headline, and I think investors should use the spike in yields that are denting technology to get back into those shares, and especially artificial intelligence. Because, Tom, if you think about long-term what drives shares, it's not so much, it's not valuations, it's not rates, but it's whether tech and stocks can deliver earnings growth, revenue growth. That's what long-term drives stocks. And so that's why I think investors would be smart to look through the near-term volatility and to enter this long-term, multi-year theme on any dips.
Tech is a broad story, of course, as you well know. Is this just AI, or is Apple a part of that story?
I mean, Apple certainly is a part of that story, but it is more cyclical versus secular. And, obviously there's an AI component to Apple as well. But, the type of tech companies that I think we should be focused on are the ones that are benefiting from this multi-year AI opportunity. So they have the secular tailwind, but at the same time, they're also benefiting from the cyclical upside as well. And again, I would squarely look to the AI beneficiary basket that I think you can find both of those.
Just to extrapolate out, though, what the longer-term implications are for other sectors outside of AI. Does this sort of decoupling and shift towards certain industries at the expense of others mean that we are going to have higher inflation or lower inflation, right? Does this boost some of these stocks, or is it just these stocks are going to grow independent of any sort of macro thesis just because of the boom in AI?
Well, if you think about inflation, and part of what's driving our inflation today is lack of labor supply. And if we are to solve that challenge, the great thing to do is to invest in artificial intelligence that has the potential to boost productivity. So I think as more and more, CFOs, CEOs, and also chief technology officers are kind of racing to boost their investments in artificial intelligence because they're trying to preserve their bottom line, I think that's what's ultimately going to provide a big boost for AI companies, because there's a bit of FOMO going on right now, and it's not in the stock market, but there's FOMO amongst IT managers that more and more of them want to make sure they're investing in AI, because if they don't and their competitors do, they will be left behind.
I'm trying to wrap my head around what the implications on a broader level are of companies investing more in AI, a number of these very specific ones doing very well, and then a whole bunch of industries doing terribly, really getting left out. And certainly with jobs that are not going to be available, cashiers getting put out of work, for example, according to the Bank of to recent U.S. data. What sectors are going to lose that are you avoiding as AI does sort of reigns supreme?
Yeah, well, I think, anything that's related to, low margin sectors like retail, for example, that's not the space that I'm very interested in right now. But if you think about long term, if you are trying to boost margins, once again, maybe you do replace some of the labor that comes with higher wages. If you do replace that with, robotics, or you replace that with automation, that's the way to preserve those margins. But I would say near term, it's not an avoidance strategy. It's more of a preference strategy. Where do I think the incremental dollar spending of IT managers is going to go? It's on that specific theme. And that's why I say, rates bumps come and go, recession fears come and go. But this is a theme that managers are prioritizing for the coming years.
And may well accelerate. It makes you wonder whether some of these labor deals are the last kind of labor deals we'll ever see like this, given that acceleration into those kind of things that you're talking about.
Yeah, I think that would be a big call to make, to say these are the last of the labor deals. And the reason I say that is, all this tremendous artificial intelligence potentially we're talking about at automation, that's not going to happen in a blink of an eye. Obviously the adoption of ChatGPT, for example, seems like it did happen in the blink of an eye. We got to 100 million users in 2 months. But it does take time to, for example, install automation in a factory. It does take time, to make sure that AI is can go mainstream. So I think that time is years and not quarters, John.
You were saying that rate spikes come and go, and I'm just curious on the other side. Yes, there's a preference for AI. The ballast, the sort of offset in your portfolio, can it still be a bond call at a time where there is such uncertainty, and your call on AI is sort of independent of that in a very strong way?
Yeah, it is. It's one of the things that we're going to continue to have the highest conviction in. But at the same time, it can be the only thing. And, I do think the other ballast to the portfolio has to be something that provides you protection against inflation being more sticky. And obviously, we have oil prices. John, you were whispering, spiking to $90.
Repeatedly.
$90 a barrel.
I'm pleased you heard it.
You caught that, huh?
Just barely.
Would you like to whisper into your mic right now? Buy tech and AI.
I think Tom is saying something about buying tech and AI.
Something actually creepy, that.
Yeah. But I would also couple that with energy, because, it's very clear that Saudi Arabia and Russia are intent on keeping oil prices elevated. And, if that's the case, that I want to be in that space as well.
Anastasia, thank you. This was wonderful. Anastasia Amoroso there of iCapital, outspoken on growth, Tom, for a lot of this year.
Well, it's great. I didn't have a chance to talk to her on this, but Brian Belsky over at BMO Capital Markets now modeling 5,000 Stolfus.
Brian's bullish now.
Yeah.
Is he?
Yeah.
Wow.
Some of them are modeling out near 5,000 as well. Like Amoroso sounds like she's on.
Isn't Brian always bullish?
Yeah.
Well, that's
but Amoroso's like she's on the edge of 5,000 there.
Bullish and right. I like Brian.
He's been bullish and right.
Bullish and right.
Yeah. But Anastasia, I think, is on the edge of 5,000. We're not hearing enough of this.
I'm not sure Anastasia said that.
No, she's not.
Anastasia's still right here.
We're getting a huge response,
You can whisper or not.
If you are just tuning in, welcome to the program. Whenever I say that, I always wonder if anyone's left. Equity futures on the S&P negative here by 0.4%. Coming up a little bit later on this morning, around about 18 minutes away, we'll catch up with Stephanie Roth, Tom, of JP Morgan Private Bank.
It's going to be interesting to see huge opinions out there on our cruise surveillance. That's what we're naming it. We're modeling it right now. And the big decision, John, is do we go Caribbean as they say, or do we go not? I don't get the cruise ship in Venice, okay? Wicked against that. The big ugly cruise ship outside St. Mark's Square. But I mean, do you go with Cozumel and Coco Cay, thank you, Royal Caribbean, or do you go with Toronto and Otranto, which is Puglia? Like you can take the cruiser on the Italian coast, John.
Wasn't impressed with the accent on those names, but yes.
I nailed it.
You can go around.
What's going on?
The heel of Puglia.
We're trying
Tom, I wouldn't take a cruise ship to do that. You get a nice fancy yacht.
What time of year would you
That's
do?
what you would do.
What time of year would you do a Puglia cruise?
I think June's nice.
June?
Yeah,
I think we
early
can get
June
that
is
in
nice.
after Davos.
Can make early June work.
Yeah,
Sure.
On a
Grandma
cruise
can be
or
there?
on a special yacht?
On a yacht.
You guys are talking past each other. He's talking full,
Oh, no, we got to do a whole cruise. Hundreds will attend, John.
You're going to cruise on a yacht.
Hundreds will attend.
You want the all-you-can-eat, all-you-can-drink,
Yeah, the thing that's like 18
entertainment,
stories tall.
where you get, sort of the shows
6
in the night.
pools. Yeah, you get
6
the shows.
pools?
Yeah, there's 6 pools.
Oh,
on
like
these
a
boats.
hotel on a tanker. I hate that stuff.
I do too, but if they pay us, who cares?
They'd have to pay. How much would it cost?
Thousands. Think what we're worth on a cruise like that.
Real money.
25 people would show up.
To get me to do that, real money. Steve England of Standard Chartered coming up.
Anastasia should show up.
Many of the indicators are now moving as we would expect them to move and are signalling that the fall in inflation will continue. And as I've said a number of times, I think will be quite marked by the end of this year. I think we are much nearer now to the top of the cycle.
So is he hiking or not hiking? Governor Bailey, the Bank of England, going into that decision on September 21st, a day after the Federal Reserve decision, Tom, a couple of weeks away today, and a week after the ECB, which is next Thursday.
I was sort of surprised by it. This is a guy that, he didn't say he wanted to declare victory, but what I would go to, John, I can't remember if we've brought this up the last couple of days, is how off the statisticians have been in the United Kingdom of gaming out UK real GDP. Basically, Governor Bailey's flying blind on a lot of the statistics.
He's not the only one.
Yeah.
He's not the only one.
I mean, it's a tough
That's
job.
for sure.
I don't think Powell's flying as blind as Bailey is about where are we right now. It's always hard.
Well, he's making a call on where he thinks we'll be at the end of the year, which is a much, much better inflation story to tell, based on what he said in those comments right there.
News flow extraordinary this morning, talking Apple, China. I've got, I'm out down to 0.9% down on 134 on NASDAQ. This just in, Anne-Marie will cruise with us in Puglia. She's all over it.
For one reason and one reason only.
Yeah,
there's a G7.
There's a little G7 there, but we could do a G7 cruise, have everybody over for cocktails.
Okay.
Aperol spritzes. Is that what
On
they
a
drink
yacht.
there? What do they drink
on a
in
yacht?
Puglia?
You can get an Aperol spritz if that's
you?
what you'd like,
Okay,
sure.
very good.
You can get anything you want.
Thank you,
Sometimes,
Anne-Marie.
Yeah.
We need 25 people to make this cruise happen, and we're down to 24 that we need.
It's a 25-person cruise.
Yeah, that's what
Okay.
Royal Caribbean says. You got to have a minimum 25 people to get the kind of suites, to get the rooms that we would want.
To get like credit at the casino. I hate that stuff.
They have casinos on board?
They have casinos on these
Do they have
boats?
Bloombergs on board? They probably have Bloomberg
They should have
terminals on board.
Bloomberg terminals
We'll have to have those.
on board.
Look for that. The
exciting
G7
one.
meetings. Balance of power off the starboard
That
rail.
works. That works. G7 next year.
Saving us here on
Sure.
equities, bonds, currencies, and commodities is a gentleman you need to listen to. If you're in equities, if you're in bonds, if you're in commodities, Stephen Englander is the definitive cross rates expert worldwide. He's never been out of a job. He holds court at Standard Chartered Bank and G10 FX. Stephen, I've got a seminar today I'm doing with Torsten Slok of Apollo and other worthies wrapped around U.S. dollar. Do you believe in dollar strength over the next 12 months?
Look, I think the momentum that it's had recently is impressive, but we know the factors that are driving it. Some robustness in the economy, weakness abroad. rates differential, primarily term premium, moving in the dollar's favor. I don't think that all of this will persist over the next year, but I think that the market is waiting to see a definitive turnaround of these factors before being comfortable selling the dollar again.
Right.
The momentum trade is clearly dollar positive at this point.
If America has a unique disinflation, how does the dollar change on a relative basis to other currencies? If we get American disinflation, how does that play into the dollar call?
Well, I think if we get disinflation with higher unemployment, it means lower rates. That's kind of what we expect. And we think that would be enough to, even in this world, to have the dollar in a gently weakening slope. For the weakening to be pronounced, I think you need to see some signs of growth elsewhere. But I would say that, from all the Fed comments, they're very skeptical about disinflation for free. So I don't think that they'll be comfortable saying, we've won. Unless they see some sign that the economy is responding. So, yes, if you get to 2% and there's no higher unemployment, the Fed will eventually ease. But I think they'll ease quicker if they see some signs that unemployment is picking up. And that would be the quickest path to dollar weakness.
Steve, let's tee up your favourite subject, and I'll tell you how much time we've got on the clock. Got about 4 minutes if you want it. Steve, do you think the labour market data is overstating the strength of the US labour market?
Right now, look, we thought QCW was going to had some risk of showing that it was much weaker than expected. That's a quarterly census, which is very accurate count of jobs. And, it showed some weakness, but mostly in Q4 of last year, nothing special in Q1 of this year. So right now, the data seem to be okay. But that said, the indications are that the labor market is slowing. What we suspect is the case is that claims are low, but that hiring is low as well. And we don't measure hiring. We don't have data on hiring in real time as we have on claims. So we're missing that aspect. But, that said, there's no ogre in the closet waiting to give us a massive downward revision.
If that's the case, Steve, what we're seeing right now are lots of ogres in the closet when it comes to Europe. Each data print that we keep getting shows a worsening outlook. Why can't the euro keep falling versus the dollar in a significant way?
You have to think, everywhere where you see this kind of weakness, that there's bound to be a policy response. I think that the Europeans are going to have to dig themselves out. I think that they so far have dealt poorly with the shock from the Russia-Ukraine war, and secondarily with the shock from weaker Chinese demand. They sort of talk about fiscal policy. They talk about investing in green technology, doing their version of the Inflation Reduction Act, which is, to stimulate investment in these sectors. I think they have to do something like that to get things to turn around. The other part about Europe is we have to see that that the slowing in inflation is confirmed. In the data, there's some, but it's not as pronounced as it is in the United States and elsewhere. So they're reluctant to talk about more hikes, and we don't have a hike in the future, but the risks, I would say, are more on the upside than on the downside.
John, don't you think the irony of suddenly now going to fiscal policy and starting to spend when rates are at the highest levels going back more than a decade, it's sort of curious.
Isn't that the European way?
Is that what we're looking at right now?
You do the right thing late?
Well,
isn't that always the way?
Can I say that the U.S. is doing that?
Go ahead, Steve.
The Inflation Reduction Act is an entitlement for businesses to invest in green technology. It's sort of uncapped at this stage. And they're taking advantage of the incentives. Europeans kind of are playing catch up on this.
Well, Steve, they don't seem to have a plan on that front, do they? What is their plan to respond to the IRA?
Well, it's always lagged by quite a bit. Eventually, they'll come up with something.
In like 5 years.
I would say that the room for the U.S. to have a fiscal response on if there's any weakness is very limited at this stage, given how bad the fiscal picture looks.
Too true. Steve, thank you, sir. Steve England there of Standard Chartered on Europe versus the United States, the policy front and what's happening in the FX market. I can tell you what's happening right now. The euro clinging to 107. We're getting so close to breaking that level. 107.02 is the low of the session. That low of the session, Tom, is right now.
I haven't done the technical work if it's a 106 handle, even a 105 handle where things give way, but there's some people really looking for a giveaway. I don't hear people talking parity. I've got a poll question that we'll have this afternoon with Torsten Slok and company, and the distribution of guesses on Euro, John, I'm not sure it includes hyper weak Euro down to 1.00 or beneath.
If you wait a minute, Tom, we might break it. 107.01, just seconds ago. Matt Hornbeck coming up in the next hour to talk about some of these issues of Morgan Stanley. Michael Schumacher of Wells Fargo. Why Mike thinks maybe the 10-year can get down to 350. We'll have a chat about that. We'll talk about tech with Emily Rowland of John Hancock Investments. All of that coming up a little bit later. We're going to lead with King Dollar. King Dollar is going to be the story we lead with a little bit later this morning.
But I would watch that. I think it's valid. And the one thing I look at here, as you know, is Euro Swissy. And Euro Swissy hasn't given away strong Swiss. The fear isn't in the system that you would indicate with strong Swiss franc. It's just not there.
Those conversations starting in about 35 minutes or so. Good to have you back, TK.
Oh, I've
missed you.
I'm looking at John. We got an ocean view for John. Lisa, you and I can be on the inside.
Nice.
We'll give Ferro the ocean view so he can wave to his family.
I appreciate that. Yeah,
we'll practice it.
It's the ocean.
Family's still there. I might go stay with them and
the royal
perhaps leave you on the boat.
The royal. I don't have my floaties
You'll swim
on.
off.
Might be the better option. Yep.
On radio and television, it is Bloomberg Surveillance. Me with a twisted bow tie. Come on, Lisa, you got to tell me. My bow tie's to port. Can't.
Well,
there it is. Lisa
Abramowicz
and Tom Keene. John Ferro on a deserved break. He's off booking our cruise surveillance off Puglia.
We haven't established what kind of boat this is going to be. Is it going to be a tanker or is it going to be a yacht?
It's one of the ugly ones that go into Venice and ruin the shores of Venice. We don't want to do that, but this is out more in the sea. No, we're out more in the sea, which is good. Right now, from sea to shining sea, we look at data, including important claims data. I'm befuddled. Michael McKee here to save the day. Michael?
Well, I'm not any less befuddled than you are because we're supposed to be seeing layoffs, at least according to the Fed. Initial jobless claims come in at 216,000 for the week ending September 2nd.
Lifeguards back to school?
That's down from 228, which was the original print. We'll see what the revision was. And take a look at this. Continuing claims, 1,679,000. That is down from 1,719,000. A huge drop in continuing claims. And continuing claims are perhaps more important right now because they're telling us how many people are actually out of work, and the number of people who are out of work and collecting benefits is falling, along with the number of people who are getting claims for the first time. So it's still a stunning number in the claims department. Quickly, non-farm productivity, 3.5%, down from 3.7. This is a revision to the second quarter. It's the final revision. Unit labor costs 2.2%. That's up from 1.6%, but these are old numbers, so they have less utility to the Fed. I can't say utility.
No, that's okay, Mike. You're getting ready for this afternoon. We'll go to Michael McKee in a moment. We do have a significant move in the market, Lisa, with the VIX out to 15.20, S&P negative 26, NASDAQ down 1% full right now. And Lisa, the bond market really moves with higher yields coming off lower yields moments ago.
And the expectation here that strength in the labor market means that this economy can keep chugging along. The euro, we've been watching the euro cracking that 107 level, 106.95 versus the dollar, as you do see strength in the U.S. continue despite the weakness that we continue to see out of data in Europe.
I'm going to look at yen, which really hasn't moved, 147.47 on yen. If that was to break out to 148, that would really get my attention. And again, I watched Swissy, which hasn't moved. So there's not that global angst, but definitely there's a feeling there of Fed action to come. Brent crude stasis $90.20 a barrel. Michael McKee is our chief R-Star correspondent and joins us here in preparation for his conversation today with John Williams. Michael, cut to the chase. He's reaffirmed a return to lower R-Star. Many people disagree with John Williams.
It's an interesting debate in the economic world, but I think the bottom line of the whole debate is that you don't know what R-Star is. So what he's talking about is a long-term return to lower interest rates, lower inflation environment. And if that's the case, then the question that follows is, what is monetary policy then? If he's wrong and the natural rate is higher, it means growth can be higher, then do we see the economy have to slow because the Fed keeps rates higher? Or do we go back to the 1990s when growth was strong, but inflation and Fed rates were higher?
And real rates were different there back to the 1990s. Right now, 1.99%. by 2 basis points higher on the 10-year at real yield. Michael McKee, hugely anticipated conversation. You will see it this afternoon here at Bloomberg with the head of the New York Federal Reserve Bank. Right now, with changing markets, a brief from Stephanie Roth, senior markets economist, J.P. Morgan Private Bank. Good luck with this data. Ferroli's going to age. He's going to get his first gray hair off of this, no question about it. How do you, within the continuum of J.P. Morgan, look at this American economy, given the shock I see on my screen, the 2-year yield, 5.03%?
Yeah, I mean, it's definitely a surprise. Claims just continue to move lower. Granted, there is some seasonality issues within the summer months, so it's possible we'll see a bit of a reversal of that when we head into September. If you look at the overall jobs picture, what we saw last week was kind of the opposite picture, and those are more a little bit less volatile data. So we saw quits rate continue to come down. That's now back down to where we were before the pandemic. You saw jobs. You know, the picture there, continue to see a rebalancing in the labor market. The 3-month average in non-farm payrolls is 150,000, which isn't that far from the break-even rate, especially if you factor in some of the immigration trends that we're seeing.
So you believe in immaculate cooling of the job market?
I think we're starting to see signs of that. It's pretty impressive. The extent to which you're seeing the job market continue to cool down, absent today's data, you're seeing wages continue to soften. The demand for labor does continue to cool down, and I think we'll just see more of this. It's been a pretty impressive cooling of the labor market throughout the course of this year. If you look at the beginning part of this year, job gains were double what they are today.
So do you believe that the Chicago Fed is correct when the new research paper dropped, where most of the effect from the 5.25 percentage points of increases that we've seen in rates going back some 18 months, that has mostly been percolating through the system, it's having its effect, and it can bring us down to 2% by mid-next year?
Yeah, if you look at inflation so far, it's come down quite a bit. Inflation, I would say, is trending around 3%. Their summer months also brought down the data, maybe artificially so. So we'll probably in the next couple months see it tick up a little bit. So I would say the trend in inflation right now is 3%. The Fed's not fighting 4.5% to 5% anymore.
Let me stay on the markets here. They are on the move here. John Ferro into the 9 o'clock on television. I'll be with Paul Sweeney here to get to the market. Opening NASDAQ futures negative 1.1% in significant retreat, down 173 NASDAQ 100 points. We go from negative 26 to negative 29 now, and SPX down 0.7%. The VIX out to 15.33. Lisa, you mentioned the euro through 107. There it is, stronger dollar. I have a 105, Lisa, on DXY.
Yeah, this is a concern for Europe, how they deal with this, especially do they have to hike rates further? Regardless, U.S. has continued to be strong, and it does seem like the soft landing still is the preeminent issue that people are talking about in the U.S. What does that mean in terms of higher for longer and possibly not seeing rate cuts next year?
Yuan, 7.33 yuan is not where it was a couple days ago. So there's sort of a global follow-on here as well. What's your conviction? I mean, you've got such an eclectic team at J.P. Morgan. What is your conviction in your belief right now? Or do you feel like you could change it? September 12th CPI, September 14th ECB. What's your belief in your theories?
So I feel good about the base case that we'll have this softish landing. Growth should probably slow in the first part of next year. But there are two tails. The one tail is that growth is better than expected in the next couple of months. And then you have the other tail where we get a more significant slowdown and the lags just take longer. And then that leads us to kind of a more material recession. So I feel good about the base case, but I think you're right. There is a lot of uncertainty around those tails.
Do you think that inflation can stay at 2% if the Fed starts aggressively cutting rates next year?
Yes, if they do it once they feel really good about the labor market cooling. So you probably need to see the unemployment rate rise a little bit more. So that 3.8% that we saw, that was largely driven by supply coming back online. In order for the Fed to really be cutting interest rates, you need to see a little bit more softness in that coming from a more material rise in unemployment.
What is that line in the sand? Is there one? Is it 4.5%, the target that they were looking at in terms of where they expected this year's unemployment rate to end?
I think it could be a little bit lower than that, somewhere in between 4 and 4.5%, especially because back then inflation was a little bit higher. Now it's come down in a pretty significant way. So the importance of getting more material slowing in the economy is just a little bit less so.
We get some pre-market moves here. Now, -30 on SPX gets my attention, but Apple, Lisa, sort of moldy all day, and now moldier. That's CFA talk.
Is it?
I got a -177, pre-market, down a solid 3.4%, and that's off a couple days of retreat.
Well, and it comes on the heels of headlines that China is banning the iPhone among certain government officials. But just tying that to the economic story is really important when it comes to what this means for ongoing trade tensions between the U.S. and China and how isolated the U.S. strength is from some of that. That, to me, is a big question mark.
I mean, the big question mark, Stephanie, is the heart of the matter here. And it comes to me, is the September meeting in play? The jargon here is Lisa reads the minutes, I don't. Is it a live meeting? Is it a live meeting?
I mean, of course, every meeting is live, but I think we're more talking about the November meeting is where we're really potentially talking about another hike. Even Waller was out, earlier this week. He sounded a lot more dovish than he's been. It seems like the desire is to pause and wait a little bit. What you saw in the beige book was just signs that there's some softening in the labor market. It kind of makes sense to just wait a meeting and then see. Our base case is that they're done hiking, though.
Lisa, save me here. NASDAQ down 1.3%.
Well, just following on this discussion around China and what's going on, how isolated the U.S. and the strength there is there any knock-on effects that people aren't fully accounting for when it comes to, I don't want to say decoupling, what do they say, de-risking, however you want to phrase it, right, that we hear about between the U.S. and China? How do you model that?
I think the real transmission is that we're getting onshoring back to the U.S. economy, right? So production is now starting to pick up here. You're getting, semiconductor chip facility production is really strong. So the structures have been one of the reasons why the U.S. economy has been so resilient. So at the margin, it's been a support for the U.S. economy and the manufacturing sector. And I think we kind of forget that China's a little bit less relevant for the global economy than it used to be. It's not really the importer of goods, especially since it's not really boosting their property market, and it hasn't for years.
Well, but given that a lot of people say that the decades of disinflation and very low inflation were driven by globalization and by importing cheaper goods from overseas, does that reverse? And this is sort of underpinning some of the angst about higher yields for longer.
I think it would take, it's a really long story, right? And we still import a much larger share of goods from China than we used to. It has come down from 2018 levels, but it's still quite high, relatively speaking. And import goods, it's really a commodities channel. So to the extent that China impacts the global commodities chain, then that's really what goes into goods prices.
So what's your run rate on real GDP now? Atlanta GDP's got like a near 6%, 5.6% number. I know you don't believe in that, but what's the math to get us to the end of the year?
We're looking at about 3% or potentially even
3%
higher.
Really?
In 3Q and 4Q, you should probably see quite a bit weaker. A couple of headwinds heading into the fourth quarter. You have student debt payments, just some seasonal factors, and the momentum should be slower then. But Atlanta Fed is very much overstated, and they know the error in their model is very high at the beginning of the quarter.
Stephanie Roth with us with J.P. Morgan. Thank you so much, J.P. Morgan Bank, this morning. These are our markets on the move. Futures at -32.7%. NASDAQ won't give it up. We're going to be -200 on NASDAQ, 1.3% down. The VIX blows out almost a stick, 15%. 0.40 as well. Standard & Poor's 500 down 0.7%.
Right now, if you are just joining the program, we've been focusing on Apple all morning, and it's one thing that it's just a specific stock, one of the biggest inputs, of course, into the NASDAQ, but also, Tom, just what the larger question is here for the growth story. And I think that was some of the angst that we heard from Seema Shah. Yeah, she was overweight, but she wasn't adding to that position in big tech on the heels of some of the
Anastasia Amoroso went completely the other way.
Correct.
And, that's what makes the show go here is we got a lot of good opinions, but Amoroso saying buy the tech AI dip. I'm not going to do that out of triple leveraged all cash, but there it is.
This is underpinning a lot of the bigger moves on the macro front too. And I think about the euro and how it's gone below 107. How much is this tech story what's underpinned the U.S. story of growth and sort of the U.S. story of continuing to increase and decouple in terms of strength versus the rest of the world? How long can that continue? And I think that's sort of being thrown into focus, especially ahead of G20.
Isn't September supposed to be, as Neela Richardson said, complex? September's always ugly. It's like
it's bad because we're trying to get our kids back to school.
No, well, there's that. How about school supplies? When did this racket start?
Yeah, well, it's textbooks. In college, that was really the key racket. I'm sorry, that to me, those textbooks, they're like $150 each.
Yeah.
Ridiculous. What kind of school supplies are you getting for your...
I don't know. She's taking physics. She needs a scale. She needs a scale that weighs atomic weight or whatever. And,
What kind of scale did you get her? And did she actually need it, or was it something that you thought was cool? Let's be honest.
Her first paper's on the physics of Nutella. That's what she's doing.
I don't want to know the physics of Nutella because I serve it to my children, so I don't want to understand that.
Lots going on. Stay with us with the VIX up a full point, 15.47. Daniel Tannenbaum, next.
China is one of the most important economies in the world and is not a country that anyone can simply ignore. We have to be eyes wide open as we engage. We have to look for where we're going to compete, where we're going to be very clear and contest based on our values, based on principles that Canadians expect us to adhere to. But we also need to look at where we actually can cooperate and work together.
That was Justin Trudeau, Prime Minister of Canada, speaking with our own Eric Schatzker moments ago as he get the lead-in, the warm-up act, I should say, to the G20 meetings in New Delhi, which start in just a couple of days. President Biden will be on his way there later today. Right now, I just want to rehash some of the stories we've been talking about all morning. And Tom, I just think that Apple is the number one story, really, of the morning, not just because it has been leading some of the declines in the NASDAQ and beyond, but also just because we are looking at the potential for Apple to get entrenched in the U.S.-China concerns. And what happens if China goes after Apple in a more material way? What does that mean in terms of the friendliness, the openness to international businesses? Or
is it an opportunity here? Let's call it a 10% correction. We're -8, and now we're more than -8, to say the least. Do the math. And the answer is, I guess this is supposed to happen. It pulls back, and the bulls have an opportunity to get resilient into the product announcements of the 12th. I don't have a clue what they're going to say. I just read Gurman like everybody else. But the answer is this a tech AI opportunity, as Anastasia Amoroso was rudely pounding the table on hours ago?
Apple shares down 3.6%. NVIDIA on the AI front. And yes, Anastasia was talking about how important it was to just believe in the long-term thesis. NVIDIA perhaps more directly tied to it, buying into weakness. The weakness down 2.6% right now. There was a couple of companies pointing to some potential softness. C3.ai said that profit will be delayed from some of their AI interface. That was yesterday. So I wonder how much people are really gut checking it or just sort of taking some chips off the table.
Well, I will have to see. I just think it's a good September trauma here in the markets. The VIX up a stick. 15.51. The VIX is starting to move. There's no question. about that. Are we done with the stock report?
Well, I was going to mention Ford, but
mention
just
Ford
quickly.
and mention the euro. I mean, the euro breaking down 107 to me is a big deal. It's not a stock.
I was about to say not exactly
It's
a
not
stock,
a stock,
but we can create a stock
euro
for it.
106.91.
Just quickly, the whole concept of unions. Ford says that it is going to offer up some additional pay to employees. This comes ahead of an ongoing tussle with UAW. The question will be, will it be enough if they're getting about $9,000 additionally per year with overtime? That is going to be.
Our guests have been great here, and particularly through a tumultuous August, and it was wonderful. We couldn't get Tannenbaum in earlier because he's got like six summer retreats he goes to. I mean, he handles it from Bar Harbor all the way down to,
He's sitting right here. You can ask him
I know.
about it.
Well, he does. I mean, we couldn't get him in August. Finally, here in September, Daniel Tannenbaum joins his partner, global anti-financial crime practice leader at Oliver Wyman, about the sum of all our fears. How do you interpret the media frenzy and lots of non-experts acting like experts about stuff you're expert in?
I mean, that's not out of sync with how things have worked for quite a while anyway. But I mean, speaking of tussles, I mean, some of the reactions you're seeing out of China, I mean, let's remember, China has had somewhat of a muted response to years of Trump aggression. They never really reacted to that. They've only really begun reacting in kind, whether it was paying visits with national security officials to a variety of American businesses, beginning to ban access to certain commodities, now potentially banning certain devices within Chinese government offices. I think we're now finding ourselves kind of in a true tit for tat that we hadn't seen before. And I think the government is still calibrating how to respond because we've had a lot of visits of U.S. government officials to China over the last few weeks and months to really try and instill business confidence, and moves like what's happened this week do precisely the opposite.
The tea leaf that I follow is foreign direct investment into China. You are hardwired to this debate with the clients of Oliver Wyman. Are corporations going to pull back, or is it a figment of our 2023 imagination?
Right now, the question I get from clients, that we get from clients more often than not, is what is everyone else doing with China? So like everyone's kind of looking around to make sure they're not out of sync. I don't see any pullback. You've already seen some companies begin to, and following kind of Janet Yellen's remarks, de-risk their supply chain, look to diversify. That's really where India has a potential opportunity on the heels of the G20 of trying to encourage more investment in manufacturing within India, obviously taking advantage of some of the challenges in China. But I think most of my clients are really looking to understand where they're potentially exposed. They may not be deepening any relationships, but they're also not pulling back.
Well, this is a compelling point. It's something that Leland Miller talked about. You just have to reframe where you see the growth opportunity in China. They're not pulling back yet. Does this up the ante, though? Did you get some frantic phone calls this morning from your retreats, wherever they may be, saying, does this change the dial if they're willing to go after Apple, which employs millions of Chinese?
I didn't get any calls on this yet today, although it's been, it's early yet. I certainly got a lot of calls on the outbound CFIUS executive order, and there's a lot of questions. There's an industry comment period that's been proposed to really look at where potential investment into China may be heavily restricted by the U.S., but there's a lot of questions on what that looks like. So it's certainly halting some investment, but it's not basically forcing a preemptive divestment.
And just when you talk about tit for tat and in foreign investment, this data came out this morning that I thought was interesting, that the value of completed Chinese foreign direct investment transactions in the U.S. was about $2.5 billion last year. That was less than half the amount back in 2009. So this, or 2021, it was the smallest since 2009. We're looking at already something that's percolating. Do you think that the companies that you speak to fully appreciate how quickly it's moving right now?
No, I don't. And again, you see actions like what happened this week on banning certain technology devices that weren't necessarily on anyone's radar. I think right now everyone's trying to keep their ear to the ground and try and react and assess their kind of risks and exposure as rapidly as possible. That's about the best you can do at the moment, which is really try and see where do I have the biggest potential challenges based on where China's going, based on where the U.S. is going from a restriction standpoint, and how do we not get caught in the middle, which is obviously the last thing companies want, is to be ground zero for some of these issues, like some banks have been over the last few years, frankly.
To shift to Europe, in Ukraine, in the war in Ukraine, the Indian relationship with Russia was complex, almost mystical. Is India our ally? Is India Ukraine's ally or not?
Yes. I think India is walking an interesting line that'll come to a head this weekend. They obviously have a prominent role in BRICS, but they're obviously hosting G20. They're trying to increase foreign investment in their country to take advantage of some of the challenges that China's seeing. And they've been taking advantage of Russia's predicament economically and buying cheap oil to further their own ambitions. I do think, and again, the U.S. has been somewhat reluctant, as have its allies, to force countries to choose a side. But I do think you're seeing the U.S. push more military cooperation with India, which it never had previously. India previously bought most of its arms from Russian suppliers. Now the U.S. is looking to try and diversify as an enticement to bring them really into the warm hug of the West's kind of side more actively.
Is this the reason why we're seeing a solidification with the potential meeting between Russia and North Korea and the leaders of those two nations, that we're seeing a sort of solidification in other areas?
I mean, Russia turning to North Korea, they're not turning to North Korea for advanced weaponry. They're turning to it for basic munitions. And I am not a military expert, nor will I pretend to be, but they're not going to the North Koreans for advanced things. They're going for the basics, which is not really a ringing endorsement for how well things are going. I do think India has an opportunity now to potentially play a much larger role in the global economy, but it is walking that line. It hasn't actively spoken out against the conflict in Ukraine. It's still buying Russian oil. It's still trying to benefit from its relationship from the U.S. and be the leader of the global South. You can only take that so far.
Dan, thanks for the brief. Don't be a stranger. It's going to be a wild September, to say the least. Mr. Tannenbaum is with Oliver Wyman, truly expert on sanctions. There will be an interview this afternoon, Michael McKee with John Williams. I don't know if they'll do a market check for you at 3:30 p.m. into the close. But nevertheless, we need a market check right now. Lisa, markets deteriorate.
And you could see that in stronger dollar, and you could see that in yields. Two-year yields now crossing the 5% line yet again after closing there yesterday. Yields higher as they game out potentially a still strong labor market.
And NASDAQ down 1.3%. Again, that's some of the Apple outflow in the coming days. Pay attention to Mark Gurman of Bloomberg News, not only on Apple Now in China, but Apple to their confab on September 12th. On radio, on television, this is Bloomberg Surveillance.